Okay.
Are we live?
Yes, we're
Yes,
live.
we are.
Yes. Okay, wait, there are 36 people on Facebook and no, sorry, 36 on YouTube and look at the camera, not look at the screen. Yes. Okay, yes. All right, good. Okay, people are coming in. Yep. Okay. Hello, everybody.
Hello.
Good evening, everyone.
Hi.
Yes. Hello.
Hello, everyone.
Okay. A bit slow on the internet. Yeah, that's unusual. Okay.
Hello.
Okay. The Facebook.
Hi, Grace.
Yes.
Hi. Hello.
Hi. Hi, Instagram. Good to see you.
Hi.
Okay. Facebook.
Today we're in some place special. Okay, it's called Money Hour.
Yes. Yes.
Finance talk.
Yes. Something is wrong there. Okay. Cool. Don't worry. Okay. Yep. B, you handle first. Okay.
Yep.
Let me see what's wrong we have.
Hello. We wait for more people to come in. Okay. Hello.
There's something wrong with this one. I'm gonna finish it. Okay. Just B, just talking.
Hello.
Oh, no wonder. On the wrong page.
Oh, no wonder.
Yeah. Okay. Don't worry.
Okay, which one is that one? That one is.
Oh no. Wait. On the wrong page. Don't worry. Don't worry.
I can't see.
Okay.
Too far away. Tell you more. Yes, today we are in the Money Hour. Okay, today is Money Talk. Okay, and this is Chun Teng. Okay, she's the
Hello.
CEO of Money Hour. Okay, I know ladies here, right? Like me, right? I struggle with like handling my finance and things like that. You know, and we thought that we will get a lady CEO to like share with you. The investment and the insurance aspect of of life. Okay, yeah. So yes, for those who wants to know more, right? Just for the slides, right? MO plus one, and then the other one, right? There's a form plus one. Okay, please key in and then get the links to the slides. Okay, yeah. Yes.
Wait, don't queue on.
Yes, we are still setting up another Facebook. We got a wrong account set up. So Lou is actually setting up the Facebook right now. Give us a minute, okay? Yeah. But
Maybe I
anyway,
say hi to the
ladies,
Instagram.
welcome.
Hi, Instagram
Yes.
people.
Okay, it should be okay now. All right.
Okay, there we are.
All right. Cool. Yes. Hello, everyone. Yes. Okay. So the slides for today is under MO plus one, Money Hour. MO plus one. MO plus one. Okay. Yes. Is it far? Okay.
Yes.
MO plus one. Yes. Okay. People are coming in. All right. MO plus one. So welcome to all the people on YouTube, on Premium Mall Facebook page, and on Instagram. Yeah. Okay. All right. We are at Money Hour today. Thank you. Okay. We have got people streaming in right now. Okay. Yes. Okay. Hey, why nobody say like and share na? Lama lah. Okay. Yes. Come on.
Got love there.
Yeah, come on. Today is really keen to see how we can get a head start on financial planning. You came to the right place tonight. All right. Okay. Charles, good to see everybody. Yes, lots of activity, lots of light. Come on, we got a very important guest here today, right? Chun Ting, the CEO of Money Hour. Big shot leh. Walao eh. Wow, how often do I get big shot for you all? Yesterday was one big shot. Today another big shot. You must thank me, man. Yeah. Okay. Okay.
Yeah, I gotta thank Mr. Lu. Okay.
Yes. Hey, you think very easy to invite big shot, is it? Yeah, very difficult to invite big shot leh. Walao eh. Yes. Cool,
You see,
right?
I got very shy.
Yeah, please, yes.
Hey, welcome everyone virtually to one of Money Hour's office. We are at Keong Saik
cannot
Road.
see.
What?
Cannot see.
Okay, no
Yeah,
problem.
yeah,
Okay,
Instagram.
yes.
Hello.
Cool, yeah, okay.
Welcome virtually to Money Hour office.
Okay, so we are very fortunate. Hi, Marie, good to see you. Yes. Grace did a like and share. Okay, Grace Chi, I'll give you a like and share price. Email me at luchengchuan@gmail.com. Okay, yes. All right, cool. Okay, yes. Good to see everybody. Okay, today the slides. Okay, on YouTube is already in the description link. And today, for those people on Facebook, okay, just type MO+1, Money Hour +1, okay. All the slides are there. you can access it directly. Cool. Okay. Yes, Marie. Thank you. Yes. Okay. Come on. Let's do some exciting like and share. Okay. Yes. How was the talk yesterday? Okay. How was the talk yesterday? Good. Good. Have some signal. Don't let it be monologue. Yeah. Okay. Incidentally, if you haven't noticed, me and B are back in Singapore. Okay. Yeah. Thanks for arranging big shot for us, Mr. Lu. Yes. Thank you. Thank you. Okay. Can you all see us and hear us loud and clear? If yes, also have some signal as well. So and if you have received the slide, say I'm ready to go. Okay. Yes. No wonder. What? No wonder. Yeah. Informative. Oh. Okay. Good. Okay. Good. Okay. Some people got it already. Yes.
I'm not commenting because I can't see anything. Okay.
You just need to look
Too
pretty.
far away. So today I'm a bus.
FB, nothing comes out. Okay. Yes, clear. Does both Facebook pages, when you type MO+1, you have the slides? Yes. So for those on Instagram, please migrate over to either Facebook, never receive slide. Can you ask Jermaine, premiummall.sg? I think I know what's the problem. Both of them are on premium.sg. Can you just check?
Live only one page.
Oh no, I made a mistake again. Yeah, just now there was a problem, remember?
Yeah.
Okay, alright, cool. Okay, I think we have some problem. I need to log off this Facebook page, okay? And then for those people on this page, can you please just go, the live video is on the same page as well. I'm gonna re-log in again, okay? Yes, okay, for this page,
Sure.
yeah. Can you just double check? The live need restart for it.
Which one?
You go to Premium Mall. Yeah. Okay. Sorry, some technical issues here.
SG or Premium Mall?
This one is SG or what is this?
This one is SG.
I think Premium Mall didn't come out. Okay. So people on this page, can you check?
No, S.SG, no slide. 没有 slides.
No. That's not a name. You got posted twice. That's not a problem. Okay. Wait. So some technical issues here. Wait.
What do you want?
Wait. I want to see whether it comes out 2 times. Wait, guys. I'm trying to solve your slide problem.
Give us a minute, okay?
1. Wait, 4 minutes ago. Can you ask Jermaine whether premium? You check whether Premium Mall. No. Check whether Premium Mall has live. Okay, wait. I'm trying to solve your slides problem, Okay. Just give us a minute.
Premium Mall.
Has live?
Yes, 7 minutes ago. Yeah, both have.
Have to. No, can you check? Ask Jermaine what's wrong? Yeah. Okay, sorry. I'm just trying to make sure that all you all have the slides. Okay. Yes. All right. Cool. Okay. But nevertheless, don't worry. We'll try to fix the slides. For those on YouTube, your slides are under description. Okay, YouTube got the link and it's working. Wonderful. Okay. For those people on this Facebook, you have got the slides ready. Okay. So once everybody is ready, please sound off you're ready. Okay. Yes. Okay. Can we also welcome our guests as well? Okay, Chun Ting. Okay, our Chun Ting is the CEO of Money Hour. Okay. Hey, very difficult to get big shots. I already told you already. Okay.
Yes, both on already.
All right. Cool.
Yeah.
All right. Good. Okay. The live is on right now. Okay. One page starts slower than the other. Live stream wasn't sure. Okay. Cool. All right. Good. Okay. So can we make sure that you check whether the slides are working? Is MO+1, not NO. Money Hour +1. MO. Okay. MO+1. Cool. Yes. Okay. All right. Good. Okay. So first of all, welcome everybody tonight. Okay. Tonight, just like yesterday night, we have an exciting night where we invite another super big shot guest speaker. Tonight we have got Chun Ting from Money Hour. She's invited here today to answer some of the toughest insurance and investment questions that you all have that I cannot answer. Remember that those days when I kind of share with you guys, how evil ILPs are and how evil some of these whole life policies are. Then many of you ask me, so how, Lou? I cannot stuck Sanko with one already. So how? What do I do now? Okay. So tonight, the expert is here. She will give you right advice. The best part is she got license I don't have. So things I cannot say, she can say. 现在你就知道我为什么这么辛苦吗 A lot of times I have the answer, don't dare to say, okay? Cool? Yes. Also for premium more sake, tomorrow, tomorrow I've got some offers, okay?
Tomorrow is the 30th of the, March. Okay, there's going to be some special deals. Okay, 7% off selected brands. So please look out for it. Okay, so join us tomorrow. Something exciting is happening. Okay, so see you all tomorrow. Okay, today nothing more from Premium Mall. Okay, if you all want something exciting tomorrow. Okay, tomorrow I'll bring you something exciting. Okay, 7% discount off Shopee. Okay, see ya. Bye bye for now.
Very important, very important. Why Shopee? Why we can get 7% tomorrow is because tomorrow is the last day of the month. They all
Yes,
chase
31st,
target.
31st.
Yes, it's the 31st.
Yeah, so they
yes.
chase target. That's why we managed to get
Yes.
something for you all.
So we help them hit the target. Okay.
So tomorrow you all must join in. That's what B said. Okay. If you all don't support her, I cannot bring important guests like Chunti come in. Yeah. Okay. Cool. Yes.
Bye-bye.
7% includes CPF. That's a good one, right? The day when I run CPF board which will never happen okay, I'll give you 7%. Okay, cool. Yes. Okay. So okay, most of you all started streaming and things like that. Can we a blast of welcome, ladies and gentlemen, a blast of likes and love for Chun Ting, okay? And today we managed to invite her. Please show your warmest welcome, okay? Show warmest welcome
Thank you.
for our
Thank
guest
you.
speaker here today, okay?
Thanks so much.
Okay, maybe I hand over time just to Chun Ting introduce herself, okay?
Great, yeah. Thanks, Lou, and thanks everyone for joining here. It's really exciting. I'm actually looking at 4 cameras and 4 of me and 4 of Lou. So it's very, very exciting for us here. Yeah, here in Money Hour office and in Keong Sik Road. In fact, we just had dinner here and we're going to be eating some local goodies. Okay, chendol cake. Mine is a sea salt. And
Okay,
roti,
remember Premium Mall is variety show. We got finance, we got handbags, and we got guest star. And today we got nice chendol cake. Can you see the chendol cake? Okay, sorry I cannot see. Okay, later when Chun Ting talk, I will eat. Okay, yes.
So, but it's very Singaporean, and actually, I just very quickly introduce at Money Hour is we are your Singapore financial advisor. So if you have the slide, if you look at page 3, we are actually a very young NTUC social enterprise. The only thing is we are not called NTUC something like, right? Because we want to be a fintech, want to be modern and all that. And for various reasons, we thought Mark Owl is a very wise character, and we were set up about 3-4 years ago as an NTUC social enterprise. So we have sister companies like FairPrice Group, we have First Campus Health, and NTUC Income is our sister company, but we are independent of NTUC Income because what we really want to do is to bring this very non-conflicted, non-commissioned advice. And so sometimes people they confuse us they say NTUC Group also you are agent for NTUC Income. That's not true. We do carry NTUC Income products, but we don't give any preference whatsoever to NTUC Income.
Wait, I want to say first thing is that they are one of the very few companies that what you call non-conflict. Simi is in non-conflict means that when they sell you a product, they are not in conflict position. Okay, yeah. Later, Chun Ting will explain to you what is non-conflict. The second thing is that any questions that you have right now, you can fire away already. We have got, I queue not a whole army of people here, all sitting there keying in the questions for you, okay? So can send in your questions right now. We'll assemble them. Along the way, we will ask, we'll make sure that your question get answered. But like yesterday, 100 over questions, I cannot answer all, but we'll try to kind of collate all the common theme questions, okay? And we'll try to answer them for everybody, okay? Ken? Okay? So as Chun Ting presents the question, presents the slides, okay? You may not be able to see it, but you have the slides, okay? Actually, there's something here, but then the Facebook cannot see very clearly. I think Facebook, this one is, YouTube is okay. So you all just look at your own slide, okay? And then we'll go on, okay?
Okay.
Cool.
So let's go on. So actually, I think Lou talked to you a lot about whole life and ILPs, right? So I just want to give you a perspective on whole life and ILPs. And a lot of times after we talk about whole life or insurance to our clients or prospects, they will say, hey, how come you were not here 20 years ago? How come you're not here 20 years ago? Why you all come born so late? Why is it that I really wanted to know, I wouldn't have bought insurance the same way. And I'm quite assure you that after you are here today, you will never buy insurance the same way, all right? Okay, so what is it really?
Never buy insurance the same way.
Yes. It's a different way of thinking about insurance. Okay.
Cool.
So, let's go on to my the next slide where I make this statement for you. Is that you do not need. Why is it that you do not need whole life insurance? Most of us do not need whole life insurance, and this because you do not need most insurance for the whole of your life. Whole life means.
I said that, right? I said that. Okay, sorry. I'm going to interrupt her a lot. She may tahan.
So you do not need most insurance for the whole of your life. That means for the whole duration of your life. Okay, so why is this so? Now, what do we buy life insurance for? Okay, in the next slide I put this. You buy life insurance for, if I want to use team words, high severity and low controllability. Okay, basically
high severity and low controllability.
So if something happened to you, the impact on you is very big. It's very jialat. Okay, so I ask you a question. Today actually there was 70% chance of rain, right? So I think there was this insurance, right? If your Grab fare go up because of rain, you can claim one. Now this is what I call no need to buy one. So then there are a lot of insurance out there. Mosquito bite lah, whatever, also can claim one accident, right? Do you really need those insurance? Okay, you have limited resources, alright? So to concentrate on those that will have an impact, those that will cost you very jialat, okay? But the other thing is that it can cost you very jialat, but then can you control it? So let's say you go gambling, just for example, right? You don't gamble lah, right? So you can control it. But there are some life risks you cannot control. It's very bo bian. So where is jialat and bo bian? Please, this is where you buy insurance. You don't buy insurance for everything.
So if you forget everything, insurance is for a scenario when you bo pian and you jialat.
Yes.
Okay, bo pian, BP and jialat JL. Okay, yeah. BPJL. Always remember. Someone put that in the comment, please. BPJL. Okay, bo pian jialat. Okay, sorry.
Next two. Okay, so in this slide, right, what you may not be able to see, but basically there are two categories of the jialat impact when it comes to life insurance. One is if this risk it happens, it causes you or your family to lose your income. So insurance is there firstly to cover loss of income. Secondly is to cover very large catastrophic medical expenses. Two types of risks that life insurance covers.
SBJL, Sibei Jalat.
Okay.
Okay, yes.
Yeah, you said all my colleagues behind here are laughing.
Okay.
Yeah. Okay, so let's talk about loss of income. The next slide. Now, what can cause you to lose income? Like this income is due to death, total permanent disability. Of course, this is loss of income for your family, right? That they depended on you for this income, but something happened to you, you died, so they need this income. So you can also lose your income due to critical illness. What is critical illness? Critical illness is like cancer, is heart attack and all that. Now you can lose your income because usually after you kena something, have to rest for a number of years, so you don't have income for those years. The third one is it may not be cancer, it may not be that, it could be something like depression. You're a teacher, you lose your voice. Imagine Lou, you lose your voice.
It's okay. And my wife won't hear my nagging. Yes.
Some like teacher lose your voice,
teacher lose voice,
depression, all that. Critical illness, you cannot claim critical illness insurance. But you lose your income for those months. Or it could be an injury and you lose your income for those months. So all this are life risks that can cause you to lose your income. And this is the insurance that you need to provide for. However, you do not need this for the whole of your life. Why is that so? Because you weren't intending or weren't able anyway to work for this income for all of your life. So that's why we say that you use term insurance, because this is a temporary need. Temporary need is until when? When do you buy this insurance until? You don't buy until you die, you buy until your planned retirement age, you can plus minus a bit, or until your last or youngest dependent becomes independent. Okay, so let's say you're 40 years old, you want to retire at 65. Okay, so then basically you buy insurance until age 65. But for whatever reason, you let's say when you are 50 years old, you want to retire at 65, but then your child just born, right? You don't have he's not independent yet. Then you buy until he is independent, like when you go to university, for example, right? So that is why we say that for a lot of this kind of risk, death, critical illness, and occupational disability, you do not need it for the whole of your life because you weren't going to have, there's no income that you to cover anyway after a certain age. Okay? Any questions here? You can please post in the chat.
Okay.
So
I
this
can
is
see
the
questions coming
very
in.
jialat one, this is jialat one because of loss of income. Now, the other one is actually due to large medical costs, can cost you to very jialat, right? Because we all know going to hospital is expensive. Chronic diseases, let's say dialysis and all that, also cost a lot of money. And the long-term care. Long-term care is the kind of CareShield Life type, if you're bedridden, you cannot feed yourself, and all that, those are also caregiving costs. So how long do you need this insurance for? These are possibly the only type of insurance that you need for the whole of your life. This one you need it for as long as you live. Now for hospitalization, from the moment you are born, now all Singaporeans are covered under MediShield Life from the moment they are born. But if you want something more, then you can buy a shield plan. And you need this as long as you live. Okay, and then the other one is long-term care. So long-term care is like CareShield Life, or you can buy a supplement. So this is where on a probability basis, you might get disabled. Of course, it's more in the elderly age line. We know that 1 in 2 people after age 65 in Singapore will probably have this problem. And so this is again for the rest of your life. So really, that's why I say for most life risks, right, you don't need a whole life plan.
You don't need a whole life plan, okay? Don't get conned by some insurance agent. Buy a whole life, siao. Okay, sorry, yes.
Okay, but then must have one question have, right? Say that critical illness, cancer, that, but I'm likely to get it when I'm old, right? So really I don't need critical illness insurance to pay for medical expenses and all that. Okay, so I think if you look at your shield plan properly, right? Cancer treatment, dialysis, they're actually chronic stuff, right? That is outpatient, and this is actually covered under your shield plan. So for critical illness, it results in 2 types of effect. One is medical expenses. That one is mainly covered by shield plan. Then for loss of income, this is where you cover yourself with a lump sum critical illness that pays out until a certain age of your working years. However, there are some treatments that are not covered by shield plan. For example, recently they said cancer drugs, the more experimental ones, actually government is not going to cover. Or you believe in alternative medicine, be it TCM or whatever, right? And so for these that are not covered, you may want to have you may then have a lifelong need for this. You can buy a small whole life. So it's not totally evil, right? So we will, in fact, in my hour, we do have a small percentage, maybe 10% or so, that are whole life plans. There are also interesting plans that are actually like a term plus whole life. They're quite multiplier. So when up to your retirement age, right, the coverage is higher. Then after your retirement age, the coverage goes down to cater for this part, right? So that's why as far as critical illness is concerned, if you understand this, right, then you realize that, oh, okay, you can actually go about coverage in a very, very cost-efficient way. Yeah. So that's the term. So it's very important to understand this is about how long you need your insurance for, because how long you need insurance for impacts the cost of your insurance.
Good. Okay. Actually, there are a lot of questions coming in already. Your next question answer one of the question here.
Okay.
Your next slide. Yeah.
So then it said, buy how much? Right?
Yeah.
Buy how much, right? So
a lot of people ask.
Buy until age 65, but buy how much?
Correct. First question is how much insurance we need. You know what's the typical amount that your insurance agent asks you? Buy as much as you can afford. Yeah.
So what's
right?
your budget?
What's your budget? What's the budget you have? Then you buy the budget lah. Siao they kena con. Why they all drive big cars and say big houses? Because you pay for it. Right? So yeah, I say one. Okay, I then swan. Okay. By the way, how much insurance you need is actually there's science to it. Not like how much budget you need. That's one rubbish. So anyway, over to you.
Okay. Yes. So how much insurance you need? This is where your advisor comes in. That there are certain concepts and it's actually calculated quite differently. It's definitely not calculated on budget. right? But of course, if you're spending more than say 10% of your household income on insurance, I can bet you that you are. It's not that you're overinsured. You're probably underinsured by overpaying.
You are underinsured by overpaying. That's the worst scenario.
So
okay.
let's see. In the slides you have a quick calculation. Okay, so let's say for death. Remember we said that death is when your family misses your income. They'll miss you also lah. Okay, but
Death is when they miss your income. Oh, it's so sad when that happens, man.
it's sad enough that they miss you.
Okay.
You don't want them to also have to suffer, right?
Okay.
So
Yes.
we already said you cover until 65 when you
Sure.
actually have an income to be missed lah.
Sure.
You know. So what do you need to? If you think about it, what do you want your family to? Firstly, you don't want to have them take over your debts. So whatever loans you have, housing loan or that is the amount of sum assured you need to buy. Then you plus, let's say any goals like children's education. Right? So if you want to cater for your children to go overseas, okay, then you must add another whatever how many 100,000 lah. Okay, but of course if you say that actually local U is enough for me, then it's not so much. Then okay, I think there's some typo here, but basically how much do your dependents need every month, right? Then multiply by 12, multiply number of years. Okay, so if your dependents every year need 30,000 and the age until you become independent is say 10 years, then you multiply that out and then you add your loans, add the children's education.
Yeah, it's here, calculated here, this formula.
Yeah, okay?
Okay.
Yeah. Okay, some people say, but inflation and all that, how? Okay, so this thing is plus minus one. Okay, you can of course just add a little bit more and all do it. It's hardly a science because your life expenses do change. All right, so this is how you calculate death and total permanent disability. Critical illness, 4 times your annual income. Okay, why 4 times your annual income for if you get cancer or if you get a heart attack? Because very sorry, it's either you die in a very short time, or when if you survive, you generally take about 4 years to recuperate, right? So that is why you buy 4 times your annual income until your retirement age for critical illness. Occupational disability, this is when you need a monthly income replacement and you will buy up to 75% of your coverage. This is the one that pays you the monthly sort of compensation, of the amount that you lose. So this is how you calculate the term insurance that you need for the life risk that cause you to lose income. So it's all around income and it's all around expenses. All right. Then what about the lifelong insurance you need, hospitalization, all that? Now here is where it is really what your preference is. Okay. Now MediShield Life is good for a lot of us. It's good for B2 to C class ward. So if that's good enough for you, you may not want to buy more. However, I think most of us want to have a bit of choice. So if you want to have a choice, if you don't want to have long waiting times, then you might want to consider the appropriate integrated shield plan. Long-term care, we have a CareShield Life now. A CareShield Life for age 30 years and above now is compulsory. So that pays about 600 plus a month in the case that you cannot do 3 of 6 what they call activities of daily living, which is like feeding, bathing, toileting, transferring, moving, etc. Now, if it's not enough, right, you can top up according to your lifestyle. So if you think if I'm disabled like this, I want to have a helper, right? So then maybe you cater for $1,000, then you buy that additional amount that you need. Okay. Now, all sounds if it sounds too complicated, right? We actually have Money Hour has a robo. Money Hour we are bionic advisor, but we're not. We don't only have investment robo. We actually have a
Bionic advisor.
Bionic means
Not
human and technology.
Human and technology, not just robo. Robo is completely machine. Bo Leong Sim. Okay. Yes. Then
Next slide.
and then after that, bionic advisor. I think that's a good term.
Yeah.
Okay. Today I learned a new term.
Yeah. So if you see on this slide, right, which is slide number 11, you can go to moneyhour.com.sg/insurance, and there are a few ways that you can few things you can do. You can just get a quote, or you can go through a journey to guide you to calculate the things that I talked about just now according to your own circumstance. Okay, so this is the how long and how much you need. Yeah, so that's
So if you go by that formula, I say again, most of you, if you go by the formula and calculate the amount of insurance you need, generally once you have kids, is a very big number. If you buy a whole life insurance or you buy an ILP insurance, you won't be able to afford it. Yeah, you won't be able to afford it. It's some phenomenally big figure. You agree with me?
Correct. Like,
yeah.
let's say 40 years old, that time we did 100,000 how much was that? I mean, it's basically a huge number.
Some
lah.
huge number,
Yeah,
half a
something
million,
like
1 million, that kind of mega banger big number. It's
Yeah,
like
but the-
one huge number.
Once you use term, right, it's like kind of 10% of what you need.
Correct. So really,
Of cost, right?
really the approach of your insurance agent asking you buy whole life, yeah, you only cover sisian tampo there of what you need. So really, you need to be able to understand. The first thing is that first thing is how much insurance you need. Yeah, once you realize that now, you realize that you won't be able to afford this kind of insurance using whole life. Yeah. Okay. Anyway, back over to you.
Okay. So then one common objection is, but then buying term insurance is throwing away, right? It's throwing away money. Whole life give me money back at least. I get back some money. So is that really true? Like that whole life you get back your money, or you earn, you can do it 2 in 1 month, save, and you can both save as well as insure yourself at the same time. Now, actually understand that when you buy a whole life plan, your premium is actually allocated in a certain way. In this pie chart you see, right, roughly about 20% is for what they call mortality charge. It's for the pooling of risk. It's for the insurance company to take on the risk that some of us will die earlier and others. So this part is the same as term insurance. It's thrown away one. It is, you will never get back. The only reason you get back something is because your other 80 cents of a dollar you gave to the insurance company to invest for you, and they're giving it back to you. So it's only there because you gave it to them in the first place. So this is why.
So it's the same, right? You invest, all this portion is also to throw away one, right? They con you to buy this whole thing, but actually this part here is thrown away. So I use very tough language, but this is what I very betahan that a lot of you all get misinformed by. Okay, anyway, I think I overbought already. Okay.
Okay, so whole life, right? If you look, there is this column in the benefit illustration, right? It says, 4.75, now lower 3 point something percent, right? This is not your return, okay? This is if the return of the what they call the participating fund or par fund returns this, then you will get this particular amount. And this policyholder bonus is added to your value of your insurance. Okay, so remember, you're not getting 4 point something percent return or that. In fact, in the best case scenarios, if they pay all bonuses, you're probably looking at over 20 years, maybe 2 plus.
You kidding?
3% or something. Yeah, and the guaranteed, right? The middle portion, the middle scenario is probably about 2%, and sometimes the guaranteed portion, right? I've even seen some plans where you don't get back your capital. So this is an IRR calculation.
Oh, wow.
Nowadays, I think it's better. MAS asks you to ask everyone to declare what the IRR is. But usually, there's a whole stack of papers and you won't bother to look at it. Okay, but that is actually how returns are. So that 80 cents that you give for every dollar of your premium to the insurance company to invest actually comes back to you with relatively low returns while having a lock-in. And why is this so? So it locks you in and has low return. Now you understand why? Because just now I use the word participating fund. Participating fund means that you participate in the return of the funds. However, the par fund, you actually share the returns with the shareholders of the insurance company. So for out of every $10 of return, right, the shareholder takes about 10% of the return. So not all the return goes to you. That's why your 4 point something is actually, in terms of your actual return to you, it becomes 2 point something. Now the other thing is that yesterday I heard you say about pooling, right? Yeah, pooling. So insurance is all about pooling of risk, right? Because some people will die earlier, some people will die all that.
I sure die late. They're very healthy. Yeah.
So you will subsidize the people who die early, lah?
Yes.
Yeah.
No, they subsidize me because I die late. I will live long.
No, that one is the CPF line. This one is insurance. Right? When
Insurance is the area.
Yeah, you scared. This one is for like
okay.
you scared to die too early. Right?
Okay.
Yeah.
Okay.
So anyway, for the insurance company, so what happens is that they need to pull this risk. They need to build this fund to have a reserve. So part of it, you cannot give up all the return to you. They must give some to shareholder. Then they must also retain some in reserves so that the fund itself can be solvent. All right. Now so these are the reasons why some of the reasons. The other reasons is that there are regulatory restrictions on how much risk your insurance company can take on your behalf. You see, when they take your 80 cents, right, they don't magically do something to it. They do exactly what investors do, which is to go to the market and buy stocks and bonds and whatever else, right? But they cannot buy very high return bonds. Very high return securities like equities, or cannot buy too much of it. Why is that so? Because the regulator are concerned that insurance companies should be solvent. So they make the companies put in certain capital to support the solvency of the fund. And so what this means is that they can't really take so much risk to give you high return anyway. And this is a control, especially under the new regime called the risk-based capital 2, RBC. So
Can you repeat what you said again? Insurance company cannot take too much risk.
yeah, because they need to put capital against that risk.
Ah.
Yeah. So let's say, for example, right, for every dollar of equity that you invest, right, you need to have capital. The capital might be, say, 16 cents or 20 cents. And under the new regime now, right, it's even fiercer because it's very volatile. Equities are very volatile. If they take too much risk, yes, you get high return, but in a year when it's down, right, very volatile, the whole fund will go solvent. Then they cannot pay to obligations.
I always wonder why insurance company, with all the super bright fund managers that they can hire, why their returns are so shit. Now I understand. It's because they are not allowed to take too much risk.
Partly.
Partly, right? So
Partly.
how can they give you good returns? Yeah.
So-
right. Now we learn something from Aceh here, right? Yeah. Hey, give a like, hello, let me Song Yang. And those people on YouTube, 400 of you, only half of you give a like only. How can, right? Let me Song Yang, please. I'm going to ask this non-stop every day. Every time I ask this. Yeah. Hey, this is incredible information. No, after today, you all become financial insurance expert. Okay, next.
This
Sorry.
is what I call the structural issues of the industry and why that is so. And the very important reason, possibly maybe even the most important reason is this: the insurance has very high expenses because they need to pay agents, advisors, commission. Okay, easily your first year commission or first year premium, I think probably all pay to or even more.
See, I told you.
It's very expensive way of saving.
Why must the insurance agent be paid so much?
Because most people don't wake up one day and realize that they need insurance. So they need to get people to sell you
Go
the
and push.
insurance. Yeah. So because we don't take care of ourselves, right? Then we have to be sold this insurance. That's why they say insurance is sold and not bought. But we're trying to change
Insurance
that.
is sold and not insurance is push, okay, and not pull. So I say again, Aceh here say I say because I say I no license like Bupake. But your first year of your premium, almost all went to pay your nice insurance agent, probably your army friend, your school friend. 10 years never see you, suddenly appear. I say I want coffee with you. Right? How many of you bought insurance like that? Say me.
Maybe about 6 years because the commission goes on for 6 years. Most of the bulk is the first year and second year, right? Then so you won't hear until about 6 years or so. Then you get called.
Is it?
Yeah, it goes on for 6 years. Most of it is in the first 2 years.
Yeah, how many people buy insurance like that? Because your friend, long time never see you. Wow, I miss you so much. Me. See me here. Everybody me, right? Wow, it's an army friend, school friend, long time never see you. Wow, you are my best friend. And suddenly after the second or third coffee,
yeah, about 3 years plus, they will suddenly call you on.
then suddenly call you and just say, hey, buy this policy from me, right? See, all of us like that.
So because of this, really, whole life is. These are the reasons. It's not that it is. Okay. Last time when interest rates and all that were very high, yeah, maybe it makes sense. You want to save, you don't see the volatility this way.
See,
but
me.
Now at 2%, all that, actually there are many instruments, that even very, very safe ones, that can give you that itself. And in fact, if you want to lock yourself in for so long, you might not break even until about 20 years or so. Yeah, because expenses are just too high and the returns are just too low nowadays.
20 years
Yeah, we've done. It's actually quite shocking. Previously, it would be earlier because the rates are high, rates of return and all that high. But now that bond yields are low and all that, at least for now, still very low, insurance companies have been struggling to pay. That's why they revised downwards the illustrated return about, I think, 1 year plus ago.
Your your insurance that you pay out take 20 years to break even, you know. Yeah, I didn't even know that. 20 years to break even.
Okay, they say I too soft. Speak louder.
It's too soft? Is it?
Yeah.
Or I too loud? No,
I'm too soft.
Okay.
Okay, speak
Can you all
louder.
hear Chun Ting? Or she needs to speak louder? Thanks so much for the hard truth.
Yeah, hard.
Ayo, I lau bak sai, I tell you, no wonder so many insurance but live in big houses and drive big cars. Who pay for their big house and big cars? I got no issue. I got no issue if they drive big cars. But I got an issue. They buy big house and big cars because you don't know their insurance product properly. That I have an issue. Whoever agree with me, hit a like, yeah.
Okay, but I want to say something about commissions now. Okay. Because
you say I eat. Okay.
Okay. On the slide, which is 14.
Mr. Lu can speak softer. Okay.
I speak louder lah.
No, I too agitated. This is a very painful topic for me. I'm very agitated. Yeah, so that's why I too loud. Sorry. Now I mellow down a bit. Like later I get agitated again. I'll speak loud. Okay, sorry.
But I must say something. It's not easy to be an insurance agent. It's not easy to be a financial
Then don't
advisor.
be. Yeah.
Okay.
Then don't be.
But it is actually a lot of the compensation is for hunting, for prospecting, because it's the hardest work in the world. It's actually to go and find people, talk to, kena whack and all that, right?
Mr. Lu eat more, talk softer. Okay. I let her talk. I talk softer. I eat more. Thanks.
Okay, so I want to say this, that commissions itself, I don't think they are in themselves evil, okay? Right, so I'll make this statement. And I do think that advisors need to be compensated because they're doing a work. They do also explain products to you and all that. And in the very purest world, right, you pay a fee for service. So you come and pay me, say $200, whatever, right? Then I advise you everything, then I don't take any commission. But in other places in the world where this is implemented, say Australia, I think UK, India, what we found is that nobody wants to serve the mass market. Because the mass market, you only need a very simple insurance. And then why will you pay me $200 to do this, right? So what happens is that the advisors in these pure models actually gravitate towards the high net worth market. So it's because the high net worth market can pay investment fees and pay upfront fees. In planning here in Singapore, high net worth might pay about $4,000-5,000, right? So I want to say that in that sense, it's not that commission agents are bad or that they give the bad advice, but it's just that commissions create conflict of interest. Okay, so many our as a social enterprise, we want to serve the mass market. We know that it's difficult for mass market to pay upfront fees totally. So what do? What we do is this: the prospecting part, right? We take away. We centralize prospecting through marketing, digital marketing, and things like that. So we don't have to then compensate advisors for hunting, and our advisors can be salaried employees. And so, but we still take the commission and retain it at company level. We rebate part of it back to you, so you lower your cost. So the way that we help you lower the cost, firstly, help you to buy the right type of insurance, term insurance that is cost effective. Secondly, we also rebate part of this commission because we don't have to pay advisors for hunting. So this is how we deal with it, and we hope that this model benefits. We believe it benefits everyone, and we hope that it can be sustainable, But of course, it does require people to understand and to take charge of their own risk. Okay, and of course for us, we are very openly advocating term insurance. So that's how we handle this issue and how we come up with our unconflicted model.
I know a lot of you have a lot of questions right now. Okay, I'm going to interrupt her, just answer one question. I have to continue. But once you finish the insurance segment, I will answer maybe half of 70% of question. Then after that, at the end of the session, we're going to answer more questions, okay? One of the questions that come out non-stop right now, I already buy ILP, I already buy whole life insurance, I cannot sangkut already.
Okay.
How?
Okay.
Right? How? That's actually the most important question, right? You agree with me? Jialat already, how? Yeah.
Okay. Can we look at, so you're convinced, so the next two slides, you say,
Yeah.
I just say, so we want you to buy as much insurance as you need and pay as little as you can, okay? So what happened now if you are there? I'll have to jump ahead. I think that is, you can refer to slide number, what is that, 20. Okay, slide number 20, okay. Now, please don't tonight go and print
Cancel
out
all your
all the terminal, cancel all your plans. I'll be doing you a great disservice if that is the effect of what you're going to do. Okay, don't go rush to cancel your plan. The long and short of it is you need to consult an advisor, okay? But don't rush. You know why? Because you might not be as insurable now. You might have medical condition. You might have you might not be able to get the coverage that you need. Okay, so you have to. If you have additional budget, then what you do is maybe you just suck it up lah, and then you pay, you buy a term insurance to cover yourself. Now I want to say this is very important, and even if you say okay, I don't have any medical condition, but at least right, get your coverage done first. That means you get your alternative fund, then you cancel. Okay, this is a very sad thing to hear, but I've heard people who have certain conditions, like let's say cyst, okay, and they don't know about it, so they didn't declare it to the insurance company. But because when you go for a checkup, realize that the cyst has grown so much, so it was actually considered pre-existing in your body, even though it's not that you're out to bluff the insurance company, and the insurance company may not pay. Right? So it is very, very important. That's why when it comes to, we are very careful about customers cancelling policies, right? So don't rush to do it. Consider some things like, do you have enough coverage? Do you have budget to supplement? Does your policy, there are some redeeming features sometimes the whole life. For example, they got this guaranteed issuance option. If there's no other way, you might be able to, upon certain life events, sometimes upsize your coverage, okay? Sometimes if your policy is really not broken even, right? Sometimes not worth cancelling, but in some cases you have broken even already, because maybe it's old policy, you had good bonuses and all that. But you can consider that there's some riders that you can cancel, because maybe some of these riders are obsolete and they are expensive. You might be able to convert your policy into a paid up plan. So what this means is that you stop paying the premiums, and then they calculate the what is the equivalent in a term insurance for your sum assured. So you still get some coverage, but you don't have to keep paying it. For ILP, right, it is probably more difficult, but in some cases you can take a premium holiday, then you don't pay for that number of years.
Okay, you say a lot of things. This sounds like rocket science. I don't quite understand. So maybe you can explain to me a bit, okay? So what you are saying is that, okay, I already have a whole life policy, okay, or ILP. I sway, I cannot con, or whatever reason it is, I already. So right now, the first thing is go and check whether we have got existing medical condition. Because we terminate now, you sway, you cannot get your enough coverage. So be careful on this one, okay? But second thing you said is that check whether your policy have broken even. But what if it's not broken even?
Then you have to see whether you can stomach that loss, because it depends how much, right?
So whether you break even or don't break even actually doesn't matter, right?
You will have to, no, if you've broken even already, then you don't have to keep paying.
Okay.
Because the cash value, if your
I see. Okay. So second thing is check whether you break even. So if you break even, you don't need to pay forever, right?
Yeah.
Okay.
So
you got it, break even, second thing, okay? But if I don't break even, so if I haven't break even, do I assume that if I got many more years to break even, so never mind, I terminate now?
You can choose to take that option.
Yeah.
But bit pain .
Yeah, but it's more pain to pay a lot more, right?
It's pain to pay a lot, but then having said that, it depends whether you have enough coverage. I think that's the most important thing.
Correct.
Like if not, you have to treat it like a very low return savings plan. Yeah, it depends, right? Because if you haven't broken even, but you're going to be 60% down, are you going to take that loss? I
see.
Yeah.
Okay.
And what is the alternative, you see?
And is there I'm asking the question for you all. I see all these questions. Very, very important. Now, whole night, this is the most important segment, okay? So if I'm only a few years to break even, so might as well go through it, right?
Go through it.
Okay. So the difficult part is I'm far away. Then I this is the one that I have to really consider. But the first thing you need to consider, as Chun Ting advice is, make sure you got enough coverage first. If you don't have, then maybe supplement your existing whole life policy or ILPs with a term insurance.
Yeah.
Right? And this one, take it like damn lousy savings plan.
Yeah.
What is the average return of this kind of savings plan?
Whole life, I mean, like I said, I think it's quite high twos maximum if they depend on when you got it lah. The older plans are a bit better.
Now,
Now high twos, I think probably.
high 2%.
High twos,
Don't
2.8
expect
like that.
don't expect more than 3%. Okay,
About that.
nowadays. So you already kena sangko already. So might as well go all the way and get an average of 2 to 3%.
I mean, the good thing about this is that insurance companies do try to pay all their bonuses lah. But they have cut bonuses. When markets are down, they will cut bonuses. But they try not to, because if they cut, right, then they lose business.
Wow, it's one very very scary and painful. Now, can you explain a little bit? There are two things. The easier one is, what are some riders on our policy that are so-called obsolete? What do you mean by that? Because you all pay a lot of riders, right? Those can go first. Yeah, because those don't contribute to your... Those are things that get burned, right? Don't contribute to your investments. Yeah.
Yeah, I mean, there's some riders that can be expensive. For example, I'm not saying they're necessarily bad, but it's tied to a whole life plan, right? For example, it's a death plan or that, but then you don't pay premiums if you get a critical illness, and if you're paying a lot for that, because that actually rider will be assessed at a critical illness kind of what do you call that, the risk, right? Or you have an early critical illness, or you got this like hospital cash, addition. If you go hospital, give $100 or whatever. Actually, they don't give you any proper coverage, but you might be paying a lot for those. So this is how you save money, in that sense. If you can't cancel the whole policy, so at least you take some of this, and then you can use this towards beefing up your coverage in other ways. So these are some of the potential.
So okay, just now you mentioned a very interesting concept I don't quite understand. I don't know whether our audience here understand. Is that what do you mean by you convert a policy to a paid up term policy or premium holiday?
Yeah. So
Simi
this is when you stop paying. When you stop paying the premiums, right? When you stop paying the premiums, then they calculate that for the amount of premiums that you pay, how much coverage is it if I convert it to a term? Right? So this is something that I don't know whether every policy has it. Some policies have this ability. You need to read your terms and conditions. Best ask an advisor. Okay.
But my advisor is a conflicted one already, so
Okay,
they'll sure ask me not to.
I don't know whether my
They will
advisors,
sure ask you not to terminate one.
our advisors may not like me saying this, but I know we have definitely served clients, who want
No, you money hour is non-conflict, but I got this company, that company, advisor, they sure, you see how you can terminate now, you lose money. Okay, guys, okay, yeah, so your advisor is important. You check whether are they in a conflict or non-conflict position, right? So I like money hour because they are non-conflict. Okay, I don't suka invite people into 165 Premium Mall channel. Okay, but I think this is a genuinely good company that I introduced you all. Okay, but anyway, so get someone who is in a non-conflict position to advise you. But can you explain what's premium holidays?
Okay, premium holiday. This is probably more for the ILPs, because ILP you can basically exercise. I think you can also do it for whole life, but in the context of ILP, you can't really do this paid up thing because there's no real coverage. It's all about investments, right? So what you do is that you say, okay, I don't want to. You exercise the clause to say that I take the maximum premium holiday. Basically, you stop investing. This is what it means for premium holiday. So at least you save for those additional amounts.
Okay, these are good. Okay, there's a lot more questions, and let's turn on our volume lah. See me? Okay. Anyway, I'm gonna get Chunti to continue with the presentation. After that, after the insurance segment, we'll rush through your questions. Then we go to the investment section. How about that? Okay, you can speed up the next part.
Alright.
Yes.
Okay, maybe we just talk about ILPs. Slide 17.
It's so far good, right? Good, right? I bring in good people for you. Right? Hey, can give a like or not? And those very young people in the YouTube, walao, 400, about 500. You all only half of you all give a like. How can? Yeah, please give a like. Please like. Okay. Yes. Okay. Now we almost got 900 people already. Yes. Alright, cool.
ILPs.
Thank you.
Okay, ILPs, money hour doesn't sell at all because we really do not see a reason for their existence. I'll just put it this way. I think they should be banned, but.
Wow, you say even more extreme than me, but she got license.
Okay.
She said, okay, I'm gonna quote
view.
her. Next time I can quote her already, right? Money hour CEO say, ILP should be banned. I also agree. I must say how many times people threaten me with legal lawsuit and things like that. Walao eh.
My opinion is that
Okay, sorry. My wife tell me to shut up. Okay, sorry. Okay.
ILPs. But firstly, what ILPs? Okay, there's an older type and a newer type. Now, I myself bought an ILP, offshore ILP when I just
Young and silly.
graduated. Yeah, and it was so terrible, really.
Young and silly.
Yeah, it's like from 2001, right? The charges were so high, and then afterwards, when market go up, it never move on. I'm wondering why. And if you look at this slide 17, right? This is the old type of ILP. Again, the allocation of your premium, right, is divided up. There is some insurance part. There's investment part. There's a huge amount of fees, about 5%, and a lot of it is front loaded. Okay, it's front loaded means you pay upfront. Once you haven't started yet, you're already down, say 5%.
Can you explain first what's ILP? There are a lot of people ask.
Insurance linked policy.
Yeah, okay.
This is when an insurance company sells you a plan that says that you have a certain you are going to make a certain return by investing in a unit trust, but you wrap around some kind of coverage in case you die. You get some kind of coverage out of it as well.
So basically, you buy a unit trust with some level of insurance in it.
Correct.
Okay.
Yeah.
So think of it like ILP is like some unit trust that you buy with insurance company that got some insurance element in it. Okay,
right.
cool.
Okay, so how is the insurance element? The old type of ILP, right? They take your premium, they allocate one part to insurance, and then maybe about 70% or so to the investments. Now this investment, right, it's not like whole life. It's not like they try to smooth and they take the fund. They centrally manage. It's according to whatever unit trust you buy. So if that unit trust returns 20%, you get 20%. The unit trust it suffers a loss of 30%, you suffer that loss of 30%. Okay. Then over time, right, in this older kind of ILP, like mine, right, it never move, even as the years pass and the investments supposedly did better as market did better, because your insurance portion, as you grow older, the charge get higher and higher. So that was the old type of ILP.
Oh, okay.
Yeah. So that's why you see it never move the value, right?
I see.
Okay. But now then people object because they say I want actually a policy where it's more invested. So now it's the newer type of ILP. The newer type of ILP we also call 101 or sometimes 105. The insurance element is 101% of the value of your investment. So if your unit trust is worth 100,000 and you happen to die, then you will get 100. That's 1 more percent. So if it goes down, then it also go down because you get 101% or 105%. So in here, that this ILP is really almost like pure investment because the protection is so minimal. Because of course, if you die, your estate can just sell off that insurance, the unit trust, right? So that is a very minimal protection kind of thing. But the charge, so the charges are very high. So what happens is that the insurance company gives you bonus units, 10%, 20%. Then say when year 5, you give you another 10%, all that. But in return, they lock you in with a long minimum investment period. Okay, there's no such thing as a free lunch really. So the more bonus you get, the longer your lock in, right? And then if you surrender any time before that, 10 years or so, easily you lose half in surrender charge. Okay, so that's why I say I don't see any use for this, because if you wanted to invest in unit trust, there is a whole bunch of stuff you can invest in. Yeah, you don't have to do this at all, and don't pay 2.5% every year for the annual charges for admin for doing this. And of course, the funds underlying it tend to be very, very high expense as well and active.
So can I just buy ILP and investment linked policy and just treat it like unit trust?
But then just buy unit trust
But what's wrong with that?
You just buy the unit trust. Because there's no why do you need to restrict yourself to the insurance company's list?
Yeah.
Then you pay extra 2.5% to the for administration and all that every year, no? 2.5% what for? And then the charges of the type of unit trust, they're also very high cost.
So Serene, just to answer your question, your ILP returns are very good, but you would have gotten an even higher return if it's not an ILP. That's basically what the answer is, right?
Yeah, because
Yeah.
the bottom line is this is what is being, it's your risk, you are taking the risk fully. But I want to tell you that in the industry, actually insurance companies are moving away from whole life and all that, and actually moving towards ILP. Again, it is because of regulation change. Because regulation says that you need, if you're taking risks to provide guarantees and payouts, you need to put more capital. ILPs, the risk is fully borne by policyholder, so don't need to put so much capital. So that's why you see that recently a lot of people sell ILPs.
Oh,
Yeah, I even had one insurance company that didn't want to work with money out because you don't sell ILP, you only sell term.
I see. Okay, okay.
Right, so that's so it's not a, so they give more incentives to advisors to sell ILPs, and there are more products there. They give you a lot of bonus units and all that, right? So you just need to be aware that these are the industry level trends, you know, and that's that's why you hear a lot about
Sure.
ILPs.
Yeah. By the way, in various Facebook and YouTube, even Instagram, we have got some money hour friends here that will answer your question directly. Okay, so you don't need to worry. So all our there are some financial advice here in a non-conflict position. We're gonna write some answers to you. So tonight, you know, we've got free advice given to you. Other time you need to pay on. Okay, sorry. Okay.
Okay, yeah. So I'm done with your insurance.
Okay,
section.
let's ask a few quick investment questions because there's a lot. Okay.
Investment or insurance?
Insurance. Sorry. Okay. What about endowment plans? Are they evil or not?
No, they're
Okay.
not evil in themselves, but it's just that the returns are not very high. Yeah, so it really depends on, like if you want to have some kind of capital guarantee and you don't mind the low returns, then we'll sell you one and give you a commission rebate. But it's really whether it's suitable for you.
Can you explain the difference between endowment, whole life, and investment link? What's the difference?
Okay, so an endowment plan is also a participating fund plan. Endowment plan is usually not for whole of life, like usually maybe for 20 years or 15 years, and they used to be mainly for children's education, but actually a lot of the insurers have pulled out this kind of education related plans because they can't give the returns, guaranteed returns, because they're quite
So actually, endowment is mainly used for like education plan,
saving,
things
like
like that.
especially
Savings plan.
yeah.
And are you saying that nowadays these kind of plans are getting less and less?
Less and less for education, yeah.
I see.
Yeah, so but we do have short-term endowments like 3 years, then it's guaranteed at 1 point something percent. Let's say 1.8% recently. Those are actually quite attractive. Like you have 3 years to. The thing about endowments is you still get locked in, but it's not for the whole of life. Yeah.
I see. Okay.
And then ILP is basically investment, right? So there is no pooling of the funds, and the return is really according to what is happening in the market that affects the unit trust value.
I see. Then for a lot of people are asking, for my kids' education, my kids planning, I want to buy something for my kid.
Yeah. Sure.
Okay, what should I buy for them?
Okay, so there are basically 2 ways to go about this, right?
Sure.
One, yes, you can still buy some kind of endowment plan, but you need to look and see whether that amount is sort of the return, because the returns are low, so it's that's you can still do that.
How much are we talking about in percent endowment?
So 2 plus
2 plus.
2 plus
2 plus.
Yeah. So
Oh, wow.
because the power fund is in the best case returns for something to the fund. Then by the time you pay the all these things share with shareholders, put the capital down, pay commission, all that.
That's over 20 years.
It can be 20 years.
You
Yeah.
kidding? 2
No, it's-
plus. 这 inflation 加个了CC 要 really.
But
So,
but
what's the
some
point of
people
buying endowment?
they like the guarantee because there is always a guarantee portion. Okay.
Oh, I
yeah,
see.
whereas you do investment, long time horizon, you can take more risk, you can get better return. However, investment is never guaranteed. So I think it is more like if you have the resources and you don't want to see volatility, you are just not suitable for investment in that sense, right? Then I guess you will, and you think that this is a good way, as a disciplined way of saving for your kid, then do it lah. It's better than nothing. It's much better than nothing. Okay,
So-
and then if you want to do it, come the money out, we'll find you the best one lah. we take quite a balanced view. Like we don't say that all these cash value plans are no good, but you just have to be you just need to understand that there is a lock-in and that the returns are not very high, but you do get some level of guarantee.
Okay, so maybe it's opportune time. Anybody wants to contact them. I don't get a single cent. Today I do this. Ask her. I never asked for 1 cent from them. But in all fairness, they treat me to a very nice coffee shop meal just now. Damn good, okay? What's the place called?
Kok Seng.
Kok Seng. Wow, Michelin star.
Michelin mentioned.
Michelin mentioned restaurant makan. That's the only thing I got from them. Please, don't think that I get commission or I get money from them.
Cake also,
And the chendol cake right now, okay? So I don't get anything from them. If you're fully declared already, okay? So and we have to eat something here today because there's some rules so that we're 1 meter apart and gotta eat something. So that's why we're eating this, okay? So don't think that we're yao kui or what. Please, it's a good excuse. However, I say again, hey, I do this thing, you must give us some affirmation now. Okay, but if you all want to contact them, okay, go ahead and contact them. There's a form, right? It's under form +1, FORM, form +1. On Facebook, you can just type form +1. You can contact them. They're non-conflict arrangement. Okay, so I think they are the best people. I recommend only the best. Okay, yes. Okay, so very good. No, I don't think your insurance agent is a crook. Someone say that. Okay, but crook, but they're in a conflict position, which I always feel that's the way. So type form +1, fill it up, send it in to them. Okay, and you will have someone to contact them, is it? Yeah. Someone contact you, okay, and then you figure out what you should do for them. Yes. Mr. Lu and Mrs. Lu deserve a meal for their effort. Yes, okay, but the meal is damn good. Okay, Kok Seng, you all can go there. I don't think it's that expensive. Okay, good, right, B?
Yeah, very good.
Yeah, very good. Okay.
Highly recommended.
My wife also. Okay, the prawn hor fun, the spicy.
Big prawn 大虾河粉.
大虾河粉 damn
Big
good.
prawn
Okay,
hor fun.
yes. So going back to this, okay. Someone said, thank you for providing a good technical explanation of how insurance work and match my understanding. That's very good. Okay. All right. Good.
Happy.
Yes. Okay. So let me ask a few more questions. Then we hand over to investment part. Okay. Just a few more questions. Okay. And some of them are specific. Okay. We haven't touched on term insurance. Are you gonna touch it later? Okay. So the question really is, how do you choose a good term insurance?
Okay.
Okay.
Good term insurance. Term insurance is actually quite simple, right? So term insurance, remember, is to cover death, total permanent disability, critical illness. Okay, I just talked about this, that pay lump sum, right? Basically, they are quite similar because they're not very complicated, right? So what you do is that you just choose the cheapest one.
But that's it. That's so easy.
Okay, and in fact, you go to our website there, right? There's one called direct comparison. Okay, choose term, choose critical illness, put in your age, all that. We rank already. So we rank by objective criteria. What is the and we declare to you what this criteria is. For term insurance, actually mainly by premium. Having said that, I know some clients they don't like UK company. They don't know what company. They want to go for NTUC income. That's fine. So in fact, we also have every month, right? Every month we publish a best term insurance comparison for critical illness on our Facebook. So you can compare all the term insurance. Like if some we don't even carry, but you can just compare the prices.
Sorry, for YouTube, I don't have a +1. On YouTube, how can they sign up their form? Can you cut a link and paste it as a comment?
Yeah.
Okay, if not, is there someone they can contact, like a general email address?
Enquiries@moneyhour.com.
Enquiries@moneyhour.com.sg.
Yeah.
Okay, enquiries with an S. Okay, so for those on YouTube, there are 529 of you all there. Okay, just go enquiries@moneyhour.com.sg. All they need to do is to just write them an email and say no, and then they will get someone to contact you. Okay, for rest of you, just type form +1. Okay, so term insurance, just pick the cheapest one. Wow, that's so easy, right? That's so easy. Do you need to worry about the stability of the insurance company or how other criteria you choose? Got 4-star restaurant, 3-star restaurant, 2-star restaurant.
Yeah, I mean there's something called credit rating and all that's there, So I think but you see, we have there's all these are MAS regulated, okay? So it's not easy to be insurance company, and you need a lot of capital, and I think in our ropo we also describe to you. If you're very kiasu, then you can take those with the highest credit rating. There's also policy holder protection fund. You know, in that if something happens to the insurance company, you have about 500,000 that is protected lah from each company. Yeah, so that's some assurance to you. I think that one very good is that MAS regulates the insurance companies very heavily on solvency and all that.
Cool. Meanwhile, can we have our Money Hour colleagues reply some of the specific questions? There are quite a lot of them, all of them. But I think there's a general question, you know, apart from ILPs, endowment, you know, term and all this.
Yeah.
What about those those unique, niche insurance like personal accident, critical illness,
Like cancer
and all this? You know, do you think all these are necessary?
Okay, I think we get the core right. So remember what we say is jialat bo pian, right?
Jialat bo pian, yes.
Okay, yeah. So you go for the highest jialat bo pian. Go and settle those first, okay? Then what happens is all these are boosters. They are boosters. So like say personal accident, again, don't buy that kind that I used to buy, you know, $400 a year, huh? Then fishbone got stuck in my throat, then I claim that kind of medical expense. Then I claim also maybe 400 lah. You know, so that afterwards it doesn't make sense, right? Because it's not really, it's not a necessary expense, because insurance is an expense. Okay, you don't need to cover every single thing in your life, right? So I would say that personal accident, yes, it's quite, if it's very cheap, it can supplement your let's say your death coverage, especially if you are young and you know, if you that's your, you want to do something like that. So again, it's when if you really have nothing better to do with your money, like in a sense. No, that's very too harsh. I think it's a supplement, you know, for that. And the things like women's cancer, all that, I guess is again another addition that you can have. But of course, if you do cancer, then if you do critical illness, that already covers that. So it might be that you feel that, you know, you have more likelihood of that, then it can be a cheap booster to that. Yeah.
Okay. Personal accident?
Yeah, like I say, the
You
type
see?
of personal accident.
Okay.
Yeah. So I think it can be personal accident can be a booster to you, but it must be a meaningful type that is jialat type, you know. So those that actually, for example, death from accident only pays out because of accident, but it does boost your death coverage. You know what I mean? Yeah. So it's, you treat it as sort of probably second tier, right? So you get your
Basic.
death, your critical illness, especially late stage critical illness, and then consider the occupational disability. If you have some more budget, then maybe you can consider that. But like I say, money is limited, it's a scarce resource. We don't only want to put fire hydrant in your house, okay? You want to make your house beautiful in other ways by accumulating for your retirement. There's a lot of competition for that single dollar.
Wow, okay. So that's a good way of saying it. Okay. What about retirement plans? Yeah, retirement plans.
Retirement income plans are actually they are reasonable. We actually have a promotion now, no, for retirement income plans. Now, retirement income plans should supplement your CPF life. Yesterday I talked about CPF life, right? CPF life is your safe retirement income floor. So, you know, you maximize your CPF as far as you can, but then you build a second layer, right? Second layer on top of that, because maybe it's not enough for you for retirement sum or ERS to pay. So then you have two options. Retirement income plan is basically like an annuity lah. You accumulate for a while. It's actually technically it's an endowment. You accumulate for a certain number of years, and then they start to pay you a payout every month for maybe about 20 years.
Sure.
There usually is a certain guaranteed amount, so people like it. So and then it's a certain fixed amount every year for 20 years. They are actually one of the more reasonable participating plans because it does force you to save, and then it returns to you. It, of course, cannot compare with CPF Life lah, but it's a supplement. It can be a second layer.
Listen, yesterday Mr. So said, right, almost nothing out there beats CPF Life. The only problem with CPF Life is it's damn cheap. Okay, so apart from being damn cheap and damn complicated, really CPF Life is very, very good. Cannot beat. This is now private sector saying, okay. So yesterday Mr. Sochining also said that, right? Okay. But however, you find that not enough, then you supplement it like what Chun Ting say with this kind of retirement plans.
Yeah.
Okay. Are these retirement plans expensive? Let's say if we compare with CPF Life, you know, how far are we from it?
Cannot compare lah.
How far?
Cannot compare. I mean the IRRs, okay, depends on how long you accumulate. Can be probably about high 3%. Yeah, but then okay, but I must tell you that when it comes to retirement income plans, for withdrawal, right, your motivation is different. You don't think about it in terms of return. You think about it in reliability of what you want, and what you want is actually that amount that comes to you every month. Okay, and think about retirement income plans is this: you pay some money to not lose money, right? And you pay a bit of return not to lose it, but you know what return is going to come to you. So this is where why it's important, and it's probably not very suitable for you if you are very young. Okay, you should be like quite close to maybe 5 years or maybe 10 years. 10 years, I think maximum you should be 15 years or so. Then you start to do this because it to basically stabilize the amount and to know for certain or with some certainty what this amount can be, right? And then you look at the payout, right? Look at the payout, the return, all that is a good reference because it's more to do with the fact that you want some guarantees and you want the stability. Now, of course, there are certain other benefits as well. For example, retirement income plan. Some of them are not full drawdown. They're not decumulation. They are income. That they income, and you can start earlier. You don't have to be until 65 years old for CPF Life. So these are some of the sort of like, it's a supplementary lah. Of course, you can also use investments, or you can use both.
Good.
Yeah.
Okay. So as you can see, that there are a lot of the insurance out there that are pushed to you. You gotta be careful. Okay. But maybe I now change it a little bit, right? Giving some questions. Okay. Is that so? What are the insurance that people should buy?
Okay.
Yeah. What are insurance people should buy? Okay. Of course, buy from Money Hour lah. But that's aside. Okay. So I just plain, hard selling here for them. But I don't get a single cent. But I got just now the coffee shop meal. But really, what are insurance that people should buy?
So let me separate the insurance into one until retirement and then one type after retirement. Okay. So for those under retirement, I think you have it in the slide. When I talk about the how much insurance you need, that's like, okay, buy a term life to cover death, total permanent disability, and critical illness. You can usually buy it together.
Buy term for death, disability, and critical illness.
Yeah.
Very important. Buy term because the cheapest and cover the most. For death, disability, and critical illness.
Yeah.
Okay. You don't understand? Type form +1. Okay. Or email at enquiries@moneyhour.com.sg. Send to them. Someone will help you on there. Okay. But really, just these three. Okay.
Then buy disability income to cover your income in case you get injured or sway and cannot work, but it's not critical illness. So then this is to replace your income. And so this is.
Is this expensive?
No, not necessarily. It's especially if you start very young, and it's to do with how much you cover of your I mean how much you earn and all that, and
any ballpark? Like
ballpark.
let's say you cover every $1,000, every $10,000, or every
Depends on
$5,000.
age.
Is it?
Yeah,
Okay, I'm 50 now.
50
Nobody cover for
50 a bit expensive lah.
Oh, is it?
50
So
a bit
young
expensive.
30.
30 someone can go on robo and check for me.
Okay, right. We'll come back to that. Okay.
So
So
usually don't cover $1,000. Usually like $3,000.
Okay.
or something like that.
True. Okay.
Okay, we check that and then we can put it in the answer.
Sure.
But I know that for young person, right, let's say 25 years, so you do all of this, right? It's usually we actually have a young adults package, right? It's like 100 plus per month, more than enough to cover.
I see. Okay.
So then there's of course hospitalization insurance. Okay, hospitalization insurance is very important. Again, consider whether you want to buy one with that gives you more, like can go private hospital or whatever, according to This one is really according to your budget lah.
This hospitalization plan,
Yeah,
right?
hospitalization
The
plan,
one that is on
Shield
top
plan,
of the
MediShield Life.
MediShield Life, right?
Yeah,
Okay.
actually that one's basic. That one is the first one I should say. That one is the first
But
one.
even MediShield Life is okay for government hospitals,
Yes,
right?
correct. Yeah.
Okay,
Yeah.
so don't look down on your MediShield Life, okay? But if you want to join the queues of public hospital whatsoever, then you get yourself covered with the hospital plan from the private hospital.
Yeah.
Okay, I do buy that as well. Okay, I do buy that as well. Okay.
Okay, so I hear that this is how many 30
Until 65.
30 years old until 65 cover how much?
I put 4K. For the
4K.
4K
salary.
for the salary. So for $3,000 a month lah, pay out. Every month $47.
Every month $47. You cover for $3,000. What's the age?
30 years old.
30 years old. This for income protection. In case you loss of
Monthly,
income, every month you pay $47 and you cover $3,000 a month. Okay,
Until 65.
until 65.
Yeah.
That's good.
Yeah.
It's not very expensive.
No. not
Okay.
really. Yeah.
Okay, this one sounds a little bit cheap. Okay, details you type form plus one, fill a form, go look for them. Don't look for me.
Yeah, this
Okay?
one's a bit cheap because it's to do with like how they calculate how much they will pay you.
Correct.
A bit cheap.
Correct. So okay, you need term insurance. Okay, you need hospitalization plan. Probably hospitalization plan if you can accept government hospital. You know, MediShield Life is quite good already. Then you need this what do you call it?
Disability income.
Disability income. I think it's good. At least these are cheap, low cost insurance. Okay. Yes.
Sorry, if you have no dependents, you may not need to buy the death plan. The term life.
All of us have some
Okay.
dependents.
Yeah, but,
all of us.
but having said that, you need your own critical illness for yourself. And it's actually sometimes it's actually cheaper to buy the critical illness as a rider on a death, the term life plan, because the standalone critical illness can be a bit expensive.
Sure.
Although there are this is where advice comes in, lah, right? So please.
Please look for them.
Yeah,
Okay,
or
if
you
not
can
this,
go online and
if
check
not
out.
this talk won't end tonight.
Yeah.
Okay, cool. Yeah. Okay. So what about any other insurance policy that you think is
Okay,
like?
so that was
Then-
up to retirement, right?
Yes.
Okay, then post-retirement or for covering of needs post-retirement, remember you continue your hospitalization plan, maybe you can consider a CareShield Life supplement. Okay, this is the one that pays you a monthly payout on cash to pay for like in diapers lah and all that on top of CareShield Life. Okay, then if you want to use retirement income insurance to supplement your CPF life, you can also consider that. Yeah. So in terms of protection needs, then it will really be death, for term life, critical illness, disability, and hospitalization, and long-term care. The retirement income is really more for retirement income during retirement.
So good. So you can see at different stages of life you need different kind of insurance, but nothing I hear called whole life insurance and investment linked policies. These are expensive and not very constructive. Okay.
Not fit for purpose.
Not fit for purpose. Okay. So the rest of it I think is worthwhile exploring. Okay. Do some research yourself. Okay. Don't say these are disclaimer. Do some research yourself. But if you do need some help, okay, Money Hour is here. Okay, you all can look out for them. Just type form plus one, fill up the form. Actually, what's the form inside? It's just contact.
Name,
Contact as well, right?
contact,
Okay.
and then you tell us what you're asking about.
So form plus one, and then for those people on YouTube, just email them at moneyhour.sg. I don't get a single cent for this referral. Please don't get me wrong.
Yeah.
But I think it's genuinely good. You go for the right thing. You don't go waste your money on the wrong one. That's why I feel very fervent and just not talk too loud. Yes. Okay. So cool. The rest of the investment question, they are very unique to yourself. I am this situation, I am this situation. We've got some colleagues here, they will try to reply you, but if you don't, you email them, they will try as much as possible to help you. Okay, if not, you come down and see them. Okay, they are not expensive, a small fee, okay, but a small fee you need to pay and things like that. But you rather pay the kind of fee than to waste.
Insurance, we don't. If it's insurance with intention really to get coverage, we don't charge. Only the comprehensive financial planning we charge.
Insurance, they don't charge. Okay, that's why they're called social enterprise. Okay, if you come and look for Mr. Lu will charge. Yeah.
Maybe we should charge.
Okay, are you guys Are you guys able to advise? Yes, that's what they do. They are they are a
of course.
financial advisor. That's what they do for a living. Okay.
Yeah.
So every time you all ask Mr. Lu for advice, I damn scared give advice. Most of the time I tell you go look for my community at the Telegram group. Someone will teach you there, not me. Yeah, but I think you can see that there is a lot of logical science to it. Okay, these are things you need to take care of. Okay, so I hope you got a good grasp of where the insurance is how much is small fee. Okay, which part of it you are charged, which part you don't. And
If you do a comprehensive financial plan with us, that means you look after your financial health, you assess your insurance needs and gaps, and then also your accumulation needs into retirement and all that, right? This is a we produce a report and then you come and see our advisors. It's currently $99, but if you're NTUC member, it's only $24.75.
$24.75. You can see a tuition teacher at A-levels, they charge you 1 hour, $120 right now. This one take care of your life.
This one can go online and do already.
Yeah.
You can do it.
$24.
And the fact finding is because I think a lot of us are NTUC members, right? So because we're NTUC Social Enterprise, so the step board Singapore Labour Foundation give a grant to you to take up this comprehensive financial planning, because when you know that it is upfront, it's an analysis for you, it is not tied to products. Okay, so and then a lot of our clients actually like that.
So I genuinely think it's a money you can afford to spend. $24 now, even zi cha also not enough. Okay, yes. So I think you all should consider it. Okay, consider it. I think it's very good. It may save you thousands or tens of $1,000s of pain. All right. So I think you all should consider that. So this one, I don't want to get involved. Okay, but is will writing inclusive?
Will writing is free now. Will writing, simple will. We have a simple will. You can go online and write a digital will for but this is a very simple will for simple needs lah.
Hey, some will go in thousands of dollars and tens of
not
thousands
so
of dollars.
complicated one.
Yeah. Okay.
So, but do write a will, and you can check it out on the page. That one is self-service.
So if tonight they come and fill out this form, do they get any freebie like free umbrella or free cake or something like that?
If our first time user, we will first. That means you're not money our client. We give you $10 capital voucher, e-capital.
$10 capital voucher. Okay, don't say Mr. Lu ever asked for you all. Hey, I got back for this kind of thing for you all. Can you at least give a like, especially those
That's the last slide. I think for second last slide. Yeah.
On insurance, okay?
Or anything.
Okay. So wait. You all this QR code. Can you all scan? You all get $10 from it. Can see not? Scan right now. And it's also in your last slide. Okay. You all scan right now if you all want. I get $10 for you for if you all become their customer. Okay. And it's not expensive to be a customer please. Okay. Yes. So that's on insurance. Okay. But fortunately, Money Hour take care of your entire financial needs. So there's a part on investment as well. Okay. Now you hear a lot of coaching, more coaching from me on investment, but also hear it from the industry experts as well, right? So yesterday we got someone to coach you on the toughest question on earth on CPF, and he spent I think 1 hour on CPF Live. Okay, and he's probably the only one qualified. Okay, I know that I trust. Okay, that teach you on this. So today we got Chun Ting to teach you and coach you. Okay, on insurance. Okay, now I'm going to segue. Okay, into investments. Okay, into investments. Okay. And I think it is very interesting to hear what they have, their investment philosophy, because that's quite in line with what I think. Okay, and that's why I brought them in to share with you. Okay, again, Mr. Lu and Mrs. Lu and B do not get a single cent from referring this, so really it's genuinely for your good. Okay, all right, cool. Okay, for those people that we miss out on your questions, we've got a lot of Money Hour colleagues trying to reply you directly. But if we missed you out, send your questions in to enquiries@moneyhour.com.sg. They will try their best to reply for you, and hopefully, just come down and see them, and maybe you'll find that you can trust them with some of your insurance needs or your investment needs. Okay, so let's go right now. Segue now into a very important how to make money. Just how to protect your life and money, right? Now how to make money. So over to you, Chun Ting.
Okay. Yeah. So In financial planning, therefore, we ask you to do it holistically speaking. And insurance is there, yes, of course, life risks happen, and in case bad things happen, but it's also there to protect your financial plan from failing, your financial accumulation plan from failing. Okay, so do take care of that as a base. Let's talk about what people like to talk about, which is making money.
Yeah, everybody like making money, right?
Right.
And my wife customer always say, Mr. Lu teach them how to make money, then after that they can buy bags from me.
Yeah, that's right.
That's so
okay,
funny.
so investing now, right? I think Singaporeans, generally speaking, they like cash and they like property. When it comes to investing in terms of stocks or whatever, there's still this fear. They think investing is very risky. So actually, why must invest? Right? Why must we invest? So very simply, you have heard this before. Make your money work for you. Compound interest. If you can invest at 5% a year, it really goes up. Doesn't go up linearly 5. No, it goes 105. Then after that 1.05 to 1. Now, not every year will be 5%. It's just that over the long run, we know that investing can actually give you above inflation returns. But you say, actually, I'm not greedy. I don't like to make money. Actually, I'm quite happy. Then I want to tell you that actually you don't invest can also be very risky. You know why? Because the compounding works on inflation as well. Right, so
listen, those people like my grandmother put the money in the bank for 40, 50 years. Okay, money cannot eaten up by inflation. Okay, you would have been a rich lady when she died if she had put it into some simple investment, but she didn't. Yeah.
So if you tell me investing is risky, I'll tell you that if you ignore it, it can also be risky to you in terms of your life goals, and all your hard-earned money can be eaten away in terms of purchasing power. So then, what do we invest in to beat inflation? If you look at the chart on this slide 23, we showed that actually capital markets. What is capital markets? Basically, capital markets is where the companies and countries go to get funding. Basically, stocks and bonds. So you see that this is a long-term chart from, I think this is in various US types of instruments. Now, US inflation is in the gray one, and you see that when you invest in stocks and bonds, then you can actually make above market returns. So this has really rewarded investors with a good return over the years. And that is what you need to invest in to beat inflation. Now, especially stocks. I'll say this, that in Money Hour, we feel that the best way, what makes you money is stocks. Bonds are there to stabilize your portfolio. Bonds are there to help you deal with the volatility of the portfolio. We actually make the money especially from stocks, because what are stocks? When you buy a stock, you're buying a share of a company. You're buying, therefore, if you buy broad index fund or something, you're actually buying, like, you become shareholders of all the different companies, like, around the world. And this is where there's upside, because companies make profit, right? So you share in those profit over the long term. Yeah. So this is what you invest in. Now, a lot of people now are very worried about inflation, because all the inflation prints, the numbers are coming out 6-7%, and people say we're going into a period of high inflation. With the war coming on, then there's this lack of oil and all this. Then they say, oh dear, maybe it's going to be stagflation, because the stagflation.
Yeah, no, I say stagflation also. Madam here also says stagflation.
Higher risk lah. Okay,
Yeah.
I don't know whether there'll be stagflation or that.
Sure.
But I want to show you this a bit chim-looking chart on slide 24, right? In which you look at the last 70 years, or no, more than that, 90 years in the US, right? And you see that the green one is where there is a positive S&P 500 return, and even when there is inflation and high inflation, people are actually making money from the stock market. Even in stagflation, if you count the number there, right, out of 12 periods of stagflation, I think if I'm not wrong, it's about 9 years you are still making money above inflation return in the stock market. So actually the best way, right, to stay to counter inflation, right, is actually very simple. Stay invested. Invest in markets. No need to go and think about all these cheap stuff like inflation hedge lah and all that kind of thing. And yes, some people will say, oh, I want to invest in commodities and all this, but actually some of these things are too volatile in themselves to really predict, to be able to hedge. Just staying invested in the stock market is actually almost your best bet and simplest way. Now, in Singapore, we don't have inflation-protected bonds. Like US, you have these tips and all that. So some people say, can I go and buy other country inflation-protected securities for Singapore inflation? This is like buying insurance on your neighbor's house. Okay, it's not, we don't recommend it because it's not, it's very complicated because inflation affects interest rates and then there's foreign currency and all that. So no, just stay invested in, sometimes the simplest solutions are actually the most effective. Okay, so why do we invest? We invest to grow our wealth, we invest to beat inflation, protect our purchasing power, and especially when there's high inflation, we should maintain this approach. Okay. Now, so how do we invest? Invest like very cheap, right? Because so many people make their life on investment. Broadly speaking, there are two ways of investing. One is the what I call active investing. The other way I want to call market-based investing. Okay. Now, active sounds very good, right? Because active, active, you know, we all like to be active, right? We don't like to be, but it is not really so when it comes to investments. Actually, a lot of times, it's not active like activity.
So you go and buy, sell. Not surely, but high chance you
Very
lose money.
Very hard to.
Yeah, this expert saying, Mr. Lu also say that for years. Okay, now expert also say that. Okay.
Actually, not me lah. We not just me lah. We have the Nobel Prize winning people, you know, who who have done the research and all this. Actually, it's a very random walk, you know, and there's a reason for it. Is that prices in liquid markets, stock market, adjust very quickly. They represent the aggregate expectations of, that means, everybody, right, already have this idea like what will the Fed do, what will happen, what's happening in the economy, and it's very hard to beat the wisdom of the crowd. Any news that comes in, you can never tell which way the market will go because a lot of expectations are already incorporated. Now, so what does active investing try to do? Active investing tries to pick the best performing region, sectors or stocks. Or they do market timing. Market timing means I will buy at this time, I will buy more bonds, I'll buy more stocks. I look at macro news and I try to predict what's going to happen. This is active investing. Now, the market-based investing is you diversify, you invest in broad markets. So I know Lou is very keen on S&P 500. Now S&P 500, yes, it is a US market, but because of the US companies, right, they are actually very global. So it is an acceptable globalized market representative, okay? And then market-based investing stays invested up and down, whatever pandemic, war and all that, right? You will never hear us saying that, okay, now we're going to take risk off the table and all that, because that's not market-based investing. So market-based investing, there's passive investing, there's also what we call systematic or evidence-based investing, which I will just touch on very lightly, okay? So let's talk about then so obviously I put two out there. We are the orange one lah, the market-based investing. Okay, I'll show you the next chart, like a tapestry. It's about diversification. Okay, so this shows that maybe y'all can guess. Actually, what country? What country was the best performing country last year? Okay, and I think a lot of people will not have guessed that.
A bit cheap, I do not read this one.
Okay, so basically, each line, each column is 1 year, right? Then the top performing country is at the top. Okay, so like in 2020, if you look at the right column, right, the 2021 top performing country was
Austria.
Like who
Really?
thinks about Austria, right? Yeah, so things like that, right? So that's what these colors all mean, right? It's just that detectors it's very hard to tell which country will outperform in any 1 year. So when you diversify, you try to invest very broadly in the markets, and that is because you don't know how to. It's a random walk. If I do sectors, it's actually that same way as well. Where certain sectors will be on top, certain sectors will be at bottom in different years. So this is about diversification. Now, let's turn to the slide number 27. Okay, slide 27 tells you that this active management, when people don't diversify but they try to pick certain sectors, certain stocks, or to move in and out of markets, actually most of active managers don't outperform the market, right, in both equities and fixed income.
I say again, just to resonate what she say, even expert professional fund managers don't do very well. They don't beat the market. Okay, most of them. Okay, so therefore, what makes you think that you, as the ordinary investor, okay, can beat them, right? Even experts also cannot do it, right? And then here we're all shouting, trying to pick this stock. That's not every day. Every day I get questioned like, I want to pick this stock. I pick a stock, Mr. Lu. What do you think? Right? Can I buy Alibaba? Can I buy Facebook? Can I buy Google? Whatever, right? Can I buy Singtel and DBS? Right? Every day I get this. I said for 1,000 times already. Don't pick stocks. You can't even beat the fund managers because the fund managers themselves can't even beat the market. Okay, so over to you. Sorry.
Yeah. So that's why also when you look at advisors, right, when they recommend funds to you, maybe you're not the one that's being active, but the underlying fund manager may be the one being active in various ways, right? So that is something you need to take note of. Now, it's not just about picking stocks, actually, Lou. It's also about moving in our markets.
Sure.
Market timing, right? They've got very nice words to it. Okay, it's called tactical asset allocation, being nimble, being dynamic, and being responsive to markets. But actually, it's being macro. But this is all about trying to guess the direction based on certain things that happen, be it geopolitics, be it what the policymakers do and all that. And it is very, very hard to do that. So, and actually the main thing is there is no need to do that, because if you're a long-term investor especially, you know that no matter how bad the crisis, the market will always recover and go up in the long run. And we see a lot of crises. Every time the crisis say, this time different, but the market always recovers and goes up in the long run. Now, why is this so? Why can I so confidently say so? There's a logic to it. Well, firstly, empirically speaking, it has been so. Okay,
History has proven it.
History has proven it. Okay, but there is a logic to it, which is this: what drives stock prices? Stock prices are ultimately driven by earnings of companies, and what drives earnings is actually demand. I'm talking about aggregate, not talking one single company. It's actually demand in aggregate around the world, and what drives demand is actually global population growth and the quest for higher standard of living. It's a human thing. So as long as we have a predominantly market economy, this will be translated into stock earnings, and ultimately stock earnings over the long run are actually really driven by the earnings more than what they call multiple expansion. Okay, multiples are basically about when people get very high on some sectors and all that. So we don't have to choose. We just basically diversify, and then that you get the market return. Right? If the market return is sufficient, then you can sleep very well, and you don't have to bother with the ins and outs.
Yeah. Here, there's a question which I think is a very important question. When you say the market, people ask you which market you're referring to. Because if you refer to the Singapore market, specifically the STI, it's quite shit. Okay, yeah. So, but if you refer to US market, it's one thing, So when you say market, maybe you want to be more specific what your market is.
Okay, the market is the global market. Basically, it's like buying everything around the world. If I can buy all the companies in the world as far as I can. So when I talk about market, it has to be a broad, diversified market. So for example, represented by indices like the MSCI World, MSCI All Country World, or S&P 500 can represent it, but I mean for Money Hour we still prefer the global indices and not just the US alone, even though US is a very big part. Yeah. So when the market, you have all these people buy, and it's just that 60% of the money in the world has chosen to buy US, and then so much has chosen to buy China, so much has chosen. So we think that there is wisdom in this, and so we try to buy everything. So you own the world, you own the world. So you don't have to own so many businesses because you don't have the capital. But when you buy a fund, or be it an ETF or be it a unit trust that represents the world, that is what I mean by buying the market. The Singapore market is not the market. Okay, Singapore market is a very small market. STI is only 30 stocks. Okay, and my bias is also this: if you are Singaporean, your earnings, your human capital is already very correlated with the Singapore market. Singapore economy go up, go down, it affects you personally. So your financial portfolio, please be global. Okay, there's no need to or for
Long
local.
Zhong come into Singapore.
Yeah, correct. Yeah. So
Yes.
that's my perspective on that.
Sure.
So STI is not the market. STI is Singapore market.
Okay, by the way, I just checked the STI today. It's not bad. It's at 3,400 points. Except that in 2007, which is 14 years ago, or more than that, yeah, 14, 15 years ago. So now it's 3,400. In 14 years ago, it was 3,800. We haven't even recovered from 14 years ago high, okay? So just to give you a few, okay? But I think I bash is enough already. Come, let's go next slide.
Yeah. Okay. So next slide, you see a picture of a roller coaster. Now this is very important because people feel that investing is very risky, and it's that, you know, it goes up and it goes down 20%. You know, I cannot tahan. You know, I want, should I cut loss? Now I want to say that when you go on a roller coaster, right? You know that no matter how bad it gets, you'll be okay one, because you're strapped in, there's centrifugal force. Now imagine the stock market is like a roller coaster, but got stop button for you. Just imagine, does the roller coaster have a stop button for you?
No.
Of course not, because what happens if you stop the button? You
drop.
drop dead. Okay, but the stock market is like this. It's a roller coaster with a stop button. So don't choose the roller coaster that is like Battlestar Galactica at Universal Studios if you cannot take it. Take the Puss in Boots one. Okay, take the Puss in Boots one, because you still get the thrill, or rather I shouldn't say thrill this way. You still get the benefit of a positive return, but you don't fall to your death. Okay, because if you cannot take the right. So that's why when we say, when you invest, how do you invest? You invest according to your need for risk. That means your need for return, your ability to take risk, which is usually to do your time horizon, because the longer your time horizon, the more you can ride it out. You don't have to withdraw your money at a time when the market is low, and your willingness to take risk, which is your stomach for the roller coaster. So it's better to stay invested, put some bonds inside so that your portfolio not so volatile, than to go for the full equity side if you know you cannot tahan. Okay, so this is basically how investment should be done.
Yep. Okay. I know some of you have some questions. As much as possible, our colleagues here will try to reply you directly, okay, or on Facebook or on YouTube, okay. But you know, we'll try to answer some of these questions after the segment on investments. Okay. Come, let's go.
Okay, so then I think there are many ladies here today. Yeah, so there's always this idea, right? I think women not good at investing and all that. So I want to, if you look at slide 30, actually in Business Times, actually women have done better than men in the last 10 years.
I told you, all right. Men don't do as good as women in investing. It's just that women don't invest as much as men. But if women were to invest, they do generally better. Why? Because men gung ho. Every time they invest, they go in and out. They buy, sell, buy, sell, buy, sell, buy, sell, sell.
So women reportedly feel less confident, but this doesn't mean they're less competent. In fact, if anything, because they think harder and they're willing to take advice, actually maybe they do better.
I also think so.
So
Yeah.
actually the approach to markets that we advocate, you know, like following markets, being market based, it's actually a more humble stance towards markets. You know, to think, not always think that you can do better and all that. And so women, I think we need to don't be so, don't knock down ourselves, right? There's something that.
And that is why today I invited a lady CEO in an industry that's dominated by men to give your.
Actually, it's true.
It's dominated by men, yeah. But why I don't? But we got a lady financial CEO here to teach you all, right? Role model for you guys, yeah. Okay.
So I think very summary how you invest. Like, firstly, diversify, broad indices, and go for low cost. That's what I know you to say. 1% more, 1% cheaper in fees means 1% more return for you, and it compounds. Okay. So I want to show you chart. They were not easy, not necessary. Stay invested for long term. Stay invested for long term.
Jenny was very funny. She says that my husband lagi paper hand. I really have to hold him back from panic selling. Yeah. So you can see, right? Men always say, I'm not so emotional. Why you all women are emotional? You can ask them how they react in the stock market. Then you say, see who's emotional. Yeah. Okay.
So for money, I will actually, whenever we have we see that markets are down, we actually get quite excited. We do advise our clients, say, hey, you have some dry powder, when you put it to work, give your plan a boost. You know, this is the only time when we say market timing. But again, not to say you miss it doesn't mean anything like, you know, because you should invest regularly, have a plan, and that's the best way to invest. Stay invested for long term, have a plan, and of course invest according to your need, ability, and willingness to take risks. You are not competing with anyone, you know. Don't have to go on social media and post your portfolio returns and all that. You don't have to do that. It's really according to what you need, and that is really about reliability and sufficiency of return. This is actually our insurance, it says insurance, and it should be investment philosophy. I want to talk. So we talk a lot about advisors, right? But I want to talk to you about fund managers, because I was a fund manager for an analyst during the crisis.
Which crisis was that?
Global financial crisis.
Wow, 2008.
Yeah,
Yeah.
2008. Yeah, I was in the CDO team actually.
Oh wow.
Yeah, and then they told me you do global banks because I was quite new to the industry.
Sure.
Then they said very stable one, and of course you know,
That's not true.
Citibank lah, Lehman,
Yeah.
those are my
Almost
those are
Conca.
my companies.
Almost
okay?
Conca Kiao.
Yeah. So what and really what I say is that fund managers are subject to certain career risks. Okay, a fund manager will take all these institutions to come. They give you 3-year mandate, and you have to outperform. You have to perform. If not, you get sacked, right? But fund managers, but you're not fund manager. So why do you take the fund manager risk? Right? You have your long-term horizon. You're not trying to beat anything. What you're trying to do is to get the returns you need to retire, that you need to say send your kids to university and all that. So really, is fund management investment is not meant to be exciting. It's not meant to be a game. It's meant to be. It's there to help you achieve your goals. So please keep it boring. Right? Keep it. Go and find your excitement elsewhere in more meaningful activity. Like buy handbag. You know, it's not meant to be.
Let the excitement be on buying handbags and not on investment.
Yeah. Okay.
Yes.
So that is that. So this is the very broadly speaking how we believe investment can be demystified, you know, and can be something that we can all handle. We don't have to be scared of investing.
Okay. So just to recap what Chun Ting said. Number one, investment. Okay. Need not be. You know, very few people actually beat the market. Not even investment fund managers. Okay. If the professionals come and do it, don't try to beat it yourself. Second is that you as a person, you must understand what you are able to tahan, okay, in terms of investment roller coaster, okay, and ladies, okay, don't look down on yourself in investment. I think you are genetically designed to outperform men. I seen that many times already, right? So I think the vast majority of Premium More audience here are ladies, right? So do not look down and say, hey, give yourself a like, man. Yeah, this actually I already said it. I got one YouTube video especially on it, right? Cool. So we'll let Chun Ting advise you what exactly you need to do now. Yes.
Okay. So here now I want to just introduce to you this idea of finding an investment solution that matches your goal. So remember, investing is not an end in itself, huh? So because we are not fund managers, investing is there to meet your financial plan, and your financial plan is there to serve your life goal. So if you look at the way, this is how Money Hour is structured investment solutions for you. Now we are not very good at you know, like selling ourselves sometimes. So we don't put a lot of bells and whistles, package a lot of stuff. We have 100 funds and all that.
You're a humble company.
And then you say like that, and then you say a humble brat.
No, humble.
Yeah. But we keep things simple, you know, keep things simple.
I help you sell.
Yeah. So what we look is reliability and fit for purpose, and then we just simple. If you don't find it in the market, we create one for you. Okay, so we have basically three types of investment goals that we have identified on slide 34. One is building wealth, accumulators. I think a lot of us are accumulators. The other one is to receive income, maybe like in retirement. So just now we talked about retirement insurance plan. The other way is actually to use investment withdrawal, and so we have actually created a solution there as well, or just to park cash. You know, park cash is for emergency fund and all that. So we have different solutions that you see. I won't really go into them except to tell you that we sometime in the next 2 weeks we will actually be launching our CPF ordinary account investment service. So that's a new exciting thing and completes the suite of investment solutions for our clients, such that you can invest your cash, CPF, and SRS all in one place. Yeah. So that's the.
You cannot give them more details, eh?
Can.
Yeah.
I can give you more details. Yeah. So actually, we talked about it on and off, lah. You know, so people have been asking me when, and so I'm very happy to confirm that actually it will be sometime before Easter. Okay. So sign up on the mailing list, and we will get back to you. But I want to say this about how we feel about CPF ordinary account. Actually, in Money Hour, we love our CPF. Okay, we love CPF as in. Not CPF investing, we only did it now because we don't think it's the main thing about CPF. The main thing about CPF is that its own credit risk-free, high interest rates for you to grow using that innate compounding power of the government's money. Yesterday we talked a lot of it with Mr. So, right? Yeah, so you cannot find this kind of return risk-free, you know, it's especially SA. So please don't invest your SA, okay?
Please don't invest your SA, your special account, okay? Give you 4 to 6%, 4 to 5% return. Very difficult to find, you know? Even experts like them, say, please don't do that, okay?
Yeah.
If the insurance agent or financial advisor asks you to do that, you know, I think you better watch out for that. I was about to say slap them, but anyway, that'll get me in problem. But okay.
Yeah. So if anything, maybe OA. Okay. So that's why our investment service also limited to CPF OA. But at Money Hour, we don't believe that everyone should invest ordinary account savings. I suppose this is somewhere where we will differ from some advisors, and especially maybe because we serve the mass market, we want to be very careful about asking you to invest in OA. So we prepared a checklist for you. So this is what we believe about who should invest CPF OA. Okay, and this is on page 35, right? Because ultimately it's not so easy to beat your CPF rates. Even 2.5%, it is risk-free, right? So if I took risk-adjusted return, it's infinite, okay? Almost infinite, yeah. So what's our checklist? Firstly, you must have a good time horizon. We recommend you should be able to keep this money if you want to invest in CPF OA for higher return around 10 years. I know you're conservative, but that's what we...
I tell them minimum 10 years.
Yeah.
Okay, minimum 10 years if you want to invest in a globally diversified index or S&P 500, 10 to 20 to 30 years, okay? Yes.
Then secondly, you must have the risk appetite. Remember the roller coaster? Your roller coaster must be at least a balanced fund, 60% equities.
Tahan ability. Okay.
You know why? Because there is long term, maybe this gives you above maybe about 5%, 5+%, okay? Look, if we cannot give you that, right, why do you want to invest rather than keep it in OA? Okay? So you must have that
Tahan ability.
Okay.
Yeah, tahan ability.
Yeah. Okay, then the third one is, are you going to use your OA? Because your OA can be used for housing, can be used for kids' education. So if you have plans already to do that, right, there is no, I got a client ask me, hey, I'm going to buy a house in 3 years' time, can I invest my OA to get the return? I said, better not. Because long-term return, yes, maybe the equities can give you, 6-7% or even more. Historically speaking, it's given you 11, but not in any 1 year period, 2 year period, okay? That's why you need to know whether you have these needs. Now, CPF OA can also be used to pay your mortgage if you lose your job. So we can recommend that maybe you keep maybe about 6 months in there, so because when you lose your income, cash becomes very precious. And when cash becomes precious, you can consider using that to release the stress on yourself. Have you considered topping up your SA? Remember, CPF is very powerful in terms of compounding a special account if you have headroom to top up for your family members as well. And lastly, in terms of if you want to invest monthly, the thing about CPF investing is that the whole ecosystem, there are a lot of charges involved. And for CPF, there's agent bank fees and all that. So if you want to do a regular savings plan from your CPF, please have at least $200. In fact, that's the minimum when you invest with Money Hour. So this is our checklist for you. So if you have cleared this checklist and you want to consider investing in a CPF OA, then we are happy to bring to you some funds. Okay, so next slide. What we have done is we have created, co-created with 2 fund managers, passive equities fund that has a share class that doesn't have pay any cut to advisors. Now this is already in the market, but very few advisors use it. But this is
Sorry, for those who are on Facebook, the slides are not under slides plus one, it's under MO plus one. Money hour plus one, okay? MO plus one, yeah, not slides plus one. Okay? Sorry, let's go on. Yeah.
yeah. Okay, so this fund is called the Lion Global Infinity Global Stock Index Fund. Actually, I used to manage this fund.
Really?
Yeah, because I was at Lion, I used to sign.
Oh, you are a lion.
Yeah,
Wow.
I used to sign the forms for the.
Sure.
So basically, what it does is it takes the money and invests in a Vanguard fund for you. But because Vanguard fund is not registered for Singapore retail investors, so they provide the legal vehicle of a unit trust. And with this being in CPF, it has been in CPF for a while, but this share class is relatively new, so you don't have to wait for rebates and all that, and the total expense ratio is 0.42%, as opposed to the full retail class of 0.8%. Now, what's the difference? These are actually because fund managers also pay commissions to advisors to help them sell. Yeah. So this is one.
Not as much as insurance agent.
No, not as much.
Yeah.
Not by far. Yeah. And the other one that we have is on the bond side. So we co-created the share class of the United SGD Fund, which is a very simple bond fund. We don't have index or passive bond funds in Singapore, in the CPF investment scheme that is hedged back to Singapore dollars, unfortunately. But this is a high quality bond fund, and it is for people who don't want the big roller coaster, you want the slightly smoother one. Then you can mix these two. So we keep it quite simple. So we have these two, and we're having 3 portfolios: balanced, growth is 80% equities, 20% bonds, and full equity, right? Which will be available sometime in April. So if you sign up for the in the mailing list, and select that you're interested in it, you can get back to me.
So this fund is available. For those people who might be interested, you type form plus one, fill it up now, and then send it to them. And those people on YouTube, find out view. First of all, each of you should give a like, but more importantly is that email money hour. No, inquiries at moneyhour.com.sg.
Yeah.
Okay?
Okay.
Yes.
So I think you don't have to go through the details. You can read them for yourself in the slides. Maybe I'll just go to maybe slide 39, slide 39 and 40. So slide 39, I've already said that what we did now is that we're quite happy to do this public service. Like, we hardwire a share class that has no advisor trailer fee, so you don't have to wait for trailer fee rebate. You don't
I always cannot understand this SIMIS trailer fee rebate.
Okay.
SIMIS trailer fee first.
Okay. Trailer fee is basically, when a fund manager has certain expenses that it charges to the fund, it don't charge you up front, but it charge you to the fund, and it affects your performance of the fund. Okay. Now, out of this is called the expenses, and it's reflected in what we call total expense ratio, a percentage. Some of it is legal fees, custodian fees, etc. Cannot avoid.
Unsumable.
Yeah, unsumable one. But
Yes.
then there is actually half of it is paid to intermediaries, especially advisors.
Like your agents.
Yeah. For us, we don't use use funds that or we don't take also any advisor.
Sure.
Yeah. So what has been done in my, which I think is very good, is to rebate these fees, right? But when you do it through CPF, right, and it easily accounts for half of the expenses, you go to CPF, it's a very painful process,
Okay.
and then you have to wait for it and all that. And ultimately, it depends on, I guess, the strategy of the advisor. So if the advisor one day not here and all that, then it won't be there. So now these share classes actually have no trailer fees or no retrocessions. That's what it means. So it doesn't matter whether you change advisor or whatever, that you can't. It's hardwired, right? So this is something that we find like a bit of public service that we're doing, and hopefully it will continue, and other funds will also do that. Yeah. So for us also, for the rest of 2022 and from the time we launch next month, we will not charge any rep fee. So a rep fee is basically a fee that is a percentage that you pay to Money Hour as your advisor. We set up platform, we balance, we give you advice and all that kind of thing. But for 2022, given it's a new service or that, we are waiving it totally.
You hear that or not? No fees.
Yeah.
Walao.
So it will be the sort of
Social
I believe
enterprise.
it's the lowest cost way of accessing these funds
Wow,
for you. Okay?
that's amazing.
Yeah.
Yeah.
So that's what we're doing. But having said that, we are confident that in 2020 we cannot run charity, huh?
Of course.
So in 2023, we are confident that you will find that our advice adds value to you. In which case, then we will ask you, we will charge something lah. If not, if I and to pay people.
Yeah.
To be fair lah.
So you're gonna do charity forever.
So then someone asked me, how come I didn't choose the S&P one? Because S&P 500 also has this particular share class, right? So for us, actually, generally speaking, it's quite simple. Like if one fund will do it, we don't do two funds. S&P 500, I think, is a very reasonable. Very quite globalized in its real exposure of businesses. But if you look on slide 40, the periods in which US outperforms the rest of the developed world is not always a given. The last 10 years definitely, ever since probably the global financial crisis, it's outperformed. But if you look at the 10 years before that, actually US quite meh, in that. So the MSCI world is actually about 60+% US anyway. So we think that it's good to have the broad exposure to global. Yeah. So that's just our view. And because we don't want to create so many things, so we just stick to that. Yeah. So that's where we are coming from.
Maybe here I'll jump in. I know. You all know Mr. Lu loves S&P 500, right? Okay. There's some of you all may be uncomfortable with a US-based fund. Okay. This is a very interesting alternative. It's a wide global fund, right? Global fund. Performance-wise, you can judge for yourself. Okay. But sometimes it may not be binary. You may not need to choose one or the other. You could have both. Okay. So I think you all should seriously consider some of these alternatives out there. They're all investable by CPF as well. Okay. So I'm not pushing any fund on this one. But I do see this as an interesting alternative. Now this is much better than you picking stocks. I pick Singtel, I pick DBS, I pick PayPal, OCBC, Grab or so. That's very dangerous. Okay, so I think this is a globally diversified fund, which I always advocate. This falls into that bucket. Okay.
Yeah. Okay, so I think that the performance-wise, you can see for yourself this historical performance. Of course, the past returns are no guarantee of future returns, but the very comfortable returns above 2.5%. For planning purposes, we will actually pick much more conservative ones for projection. But ultimately, I think you see why invest. I think I saw a story about how we are different and all that. But we are a comprehensive advisor. So of course, in the area of investments alone, we will also then offer you cash, SRS and CPF digitally in one place. So we are the second digital CPF IS investor. Why we were late, I think I explained to you just now, because we're actually more focused on comprehensive planning and using CPF more in the kind of CPF life area for retirement planning. We also have no sales charge, and in this case, like I said, we are going to use the retrocession free rebates, and we kept it simple. So we are really more into simplifying rather than multiplying. We see ourselves more as really advisors. Not so much a platform where you pick and choose. There's a place for that, but for us, I think we pride ourselves on advice, and in particular on comprehensive advice. When it comes to CPF, we also will not just say invest it all, even though that benefits me in terms of getting AUM. If you are not suitable, we'll tell you you're not suitable, and that's why that's just our social enterprise way of going about things. So I guess if you want a lot of variety or that, perhaps we may not be the one for you. If you are mainly looking only for cost, then we are still going to be the lowest cost, I think, for this year for access here. But ultimately we want to be able to speak to you about comprehensive planning for your CPF, not just about investing your excess CPF. Yeah, so I think that's all that I have in terms of content. Actually, we said many times already, do approach us to. We may not answer a question, though I do see my colleagues are working very hard. Yeah.
Yes. So anyway, I think for just now the money hour portfolio, there's a slide on it. The returns are here. Okay. I think over the last 2012 to 2021, they're looking at a full equity about 11%, north of 11%. So it's very good already. Okay. I'll be happy to get 8% or so. So I think that's a very interesting portfolio. So as I say, it need not be binary, right? You need not be fully S&P 500 or fully global. It could be both, right? Or you could choose one. So the key thing is, not to just harm everything to Singapore. That's one of the most serious thing that you can do.
And keep
okay,
costs low.
and keep your costs really low. Okay, yeah. So someone asked us, S&P 500. Do you offer S&P 500 for SRS investing?
No, because for our cash and SRS currently for accumulation, we are on the dimensional portfolios, which is the systematic investing, where it's also market based, but it's based on select academic research. Yeah. So like you say, we are really more advisors, so we curate our funds very, very fiercely. Yeah. So we don't really offer like individual funds as such.
Okay. So what I'll do right now is I'll quickly run through some of the questions and let's speed it up a little bit. I hope to cover about these questions. Some of them may be specific. If you have any questions, now's the time to fire. We'll have about 20 minutes or so of Q&A, then we can wrap it up a day. So let's, if any questions, start firing them right now. Our colleagues will try to answer them. If not, they, well, you can, these questions, you can also send them to enquiries@moneyhour.com.sg, okay, and they'll try to reply you as well. But let's try to answer as much questions as we can, okay? Are there any funds for SA shielding? I think they look at bond funds or things like that, yes.
Okay, so currently we don't offer that, but if you're asking me for what are the funds that can be used for SA shielding, basically look through the very low risk bond funds. That the United SGD fund is a decent one that you can use. But okay, given where bonds are nowadays, you may not. There's still some risk of price loss, so just have to be aware of that.
Okay, all right, cool. Money Hour, the slide states that advisory fee for 2022 is 0%. What would be the advisory fee after that?
Okay, so this advisory fee is capped at 0.4%. And so that 0.4% is actually really very, very low because there's no sales charge or anything. So that's probably where we will end up at.
Okay. Our colleagues typing fast enough for the question. I see a question here. I didn't see the question here. Okay. Yes. Okay. Yes. So I'm trying not to touch the insurance question yet. Okay. What are the? Sorry. If invested with SA, should we withdraw? That means can we withdraw? Maybe if I invest with SA.
You invested already with
Yes.
SA?
Yes.
Yeah, I mean the of course you can redeem your investments anytime and the money goes back to your SA. Definitely can.
Okay.
Yeah.
Yep. Okay. I'll start covering some of the insurance questions as well. What's Money Hour stand on children investments? Children insurance.
Okay, children's insurance, right? Okay, firstly, most important, you protect the goose first, the goose that lays the eggs, which is yourself. But children's insurance, it's good for some things. Children, you don't need to buy them life insurance, right? Because they don't have income to cover. But there is a case for buying maybe some critical illness or early critical illness, because it might, if the child is ill, you as a parent might want to take some time off. And the other part is that it has a bit of insurability locked in for your child. So again, this is what I say is not the priority, right? So you might want to consider that later. The good part about children insurance is very cheap. Yeah. So if you have the budget, you might like do them a favor in that sense, lock it in for them. Yeah. But again, it's not a priority.
Can share. Okay. Can the people asking about CareShield Life supplement? Can you share more about it and what's your view on it?
Okay, so CareShield Life currently.
Maybe first you explain what's CareShield Life.
Okay, CareShield Life, right, is the government will pay out this monthly payment when you are severely disabled. Now, severely disabled is not the same as some of these other disability, like it is defined by not being able to do 3 out of 6 activities of daily living. Washing, feeding, toileting, dressing, transferring, from chair to bed, and mobility lah. So if you cannot do 3 out of 6, then you are considered severely disabled. Then CareShield Life will kick in. So CareShield Life currently the payment is probably, if I'm not wrong, should be 630 or something like that. If you get disabled this year, increases by 2% per year. So this is what you already pay through your premiums that can be paid by CPF, and this is paid to you. Now, but the thing is, this is paid in cash. So you can use this. What do you use this for? Now, remember, hospitalization is covered by your MediShield Life or Integrated Shield plan. So this is really more for caregiving expenses, like you need a helper, or you want to hire some home help, or nursing home. These things. Now, what is the average cost then? Is 600 enough? Now, bear in mind you have CPF Life as well coming on. So it is, if that income and also help, because you're still living, it's either disabled living or healthy living, right? But if you want more than that, then you can buy a supplement on top of that. And we do recommend that you look into it, because caregiving expenses are probably increasing. With nursing care, all that, and maybe next time we don't have helpers, so we might need a little bit more, at least really to ease that. So what we ask you to look at is to consider some CareShield Life supplements. You can actually use your CPF MediSave to pay for up to $600 in your MediSave to do that. What we recommend is that you buy the one that is also pays out only at 3 activities of daily living. Some have lesser criteria, like 2 they pay already, but usually when you have 2 you also kena 3 lah. Yeah, so that's our general advice to pay for that. And you can also consider one that escalates. That means after you start to claim, it goes up in accordance to inflation. Because one thing about the government shield things, right, like CPF Life and CareShield Life, is that during the time of payout in retirement, it doesn't really hedge inflation very well, because it doesn't go up with inflation. Yeah, so this is our general advice. Of course, you can get a quote and also get our advisors to talk to you about it.
Okay, I know there's a lot of questions on specific products of specific products of companies, other companies, and how does the money hour compare this company, that company. I'm gonna park those company under specific questions that you should write in to them directly, okay? Yeah, because those are very specific and unique, and I'd rather you write them in. But I'm gonna ask more general question, like universal insurance. What's your view of it? Universal life, yeah.
Okay.
I heard this is also another poison. Okay.
Well, universal life. Okay, we are not fully decided on universal life, but except that universal life might be quite an expensive way of trying to accomplish too many things at one go. It's really about choosing your coverage versus a crediting rate. And the main thing about universal life is that there might be an alternative, right, to having, say, a term plan that pays out until, say, age 99, and then investing the rest instead of bring it to the company to do. The lock-ins are, it's not so much the lock-in, but more like there's usually a crediting rate, and then there's usually financing that makes it worthwhile. But when it comes to financing, there's always the question mark now, interest rates going up. I think for most people, it's still a very expensive way of settling your I suppose your legacy. There might be other ways to do it that are more flexible.
Yeah. Is there a role for insurance on legacy planning?
Yes, I think there is.
For example,
we have the.
I mean, for example, in US, one of the way they siam estate duties is they buy insurance, but Singapore don't have this kind of complexity of this kind of estate duties. So, is there something along this line that we need to buy insurance for that purpose?
I think it can be. I mean, it can be done that way. And there are some plans whereby, you know, it's like you pass on to the second generation and third generation and so on. But again, it's that they tend to be very expensive. One thing that we can do in Money Hour is we can actually set up a joint investment account even with your kid. Not many advisors actually manage to do that, and totally online as well. And so in that way, you don't have to pass, you know, one to the other in that sense. I know whole life plans are also used for legacy planning as a universal life, but again, very expensive, you know. So and you need to balance, because you need to balance between legacy and you know, not and having enough to live on and live happily.
Okay. What's the difference between CareShield and ElderShield?
CareShield is the upgraded version. Yeah.
Okay.
So CareShield, like ElderShield used to pay for 5 years,
Mhm.
so 6 years,
Mhm.
and it's got $300 or $400.
Mhm.
ElderShield pays higher, and it pays from the point when you're severely disabled until the point when you are not. But you know, if you are as disabled, that is likely to be for life.
Okay. Is our MediShield Life actually adequate for us? You know, why do we still need to buy hospitalization plans?
Yeah, so MediShield Life is for B2 or C wards, and actually our healthcare system is actually very good. Even my father now also, he's 80 plus, we will put him in the B2 ward. So you know, actually when you're old, you don't really like to be in a
Single room.
Single room.
Yeah, it's very
and all
scary.
that,
Yeah.
And the level of care is good, but MediShield Life itself, I guess, doesn't they don't cover, say, pre and post hospitalization, for example, and public hospitals can be under quite a lot of strain sometimes, so your waiting times may be longer, and then also on top of that, you don't get to choose your doctor, and sometimes these things are important to people. So you can consider, if you are able to buy a sort of a private shield plan first, and then maybe later on, if you want to downgrade, then you can consider that.
Okay, cool. Okay. I know the time is rather short right now. Maybe I'll take 1 or 2 more questions. What I'll do, I thought about it because there are about 90 over questions and the questions still coming in. So I will answer. I'll get Chun Ting answer a few questions. What we'll do if you're okay is that maybe you get Money Hour to answer some of these questions on paper. I'll post up all this Q&A for you guys. Okay, in our, and then you can go and read about it, so it will benefit everybody. How about that? Okay, so let's take one or few more questions. Okay, this one is quite interesting. Everybody but talk about SAF term insurance.
Yes.
It's like the best term insurance. Okay, I didn't know SAF term insurance is offered by SAF themselves. Okay, or do they outsource to another company?
No, it's Aviva.
Ivavi, okay. What is it the best?
Okay.
Yeah.
I have no.
You have so.
Because
you know SAF, how many you can buy?
MINDEF,
Oh, you MINDEF.
Yeah,
Okay,
because
okay. Ex-MINDEF.
my first job was a
Yeah.
MINDEF civilian
Sure.
officer. Yeah, so MINDEF MHA and open to NS men. Okay. Now SAF is a group insurance, and group insurance means that the entity negotiates on behalf of the group, right?
Because SAF is so big.
MHA also, right?
Yeah.
Now, the pure deaf one is very cheap, right? And it's worthwhile getting. It's actually worthwhile getting. But the CI riders, all that, right? They go up with age. So it's not necessarily that it will be cheaper in general, and because your cost will also increase over time. So that's one consideration. The other consideration of general group insurance, that at Money Hour we advocate that your group insurance should form maybe about 50% of your total insurance. SAF one is actually good because it's portable. You know, the other insurance that are not portable and all that. So you can consider the deaf one, but group insurance also means that the terms are not up to you. The terms can be changed. So about 2 years ago, we had the critical illness definition changed for what constitutes critical illness, and so for some policyholders, they retain the old definitions which they preferred, but then for SAF group insurance, it all changed together because it was negotiated by the group. So there are some things that are outside your control when it comes to group insurance, and so what we generally say is that, well, maybe about 50% of the coverage can be that, and in fact we would recommend that you take a look at the SAF group insurance if you're eligible.
Cool.
Yeah. But mainly on the death one, the one that is critical illness and all that, right? You might want to consider getting as soon as possible when you're young and healthy, and then have level premiums until age 65.
Cool. All right. Good. Okay. So with this, maybe what were just to recall, today we have actually covered two major segments. Okay. Number one is a whole section on insurance. So by now we learn what is what is the right insurance strategy we should adopt, and those things that we consider not suitable for us, we know what are the paths for us, the way out, right? No matter how painful they are, at least we know the way out. How do we get ourselves way out? Whether we should get ourselves way out, okay? And the other one is on investment, right? Chun Ting literally just reiterate what I've been sharing with you all for months, okay? That we should adopt those kind of investment strategy, okay, for a long period of time, globally diversified fund. If you are interested in what they are offering, okay, they do have a globally diversified CPF available fund launching in April, okay. For those on Facebook, you just type a form +1 and fill up the form. For those on YouTube, okay, just email them at enquiries@moneyhour.com.sg. Okay, so they are a great company. So we managed to invite them to speak to us. It's a great educational session, right? So whatever questions have, we'll try to get their colleagues to write them down. I'll put up the Q&A. Okay, I'll put a Q&A on a link somewhere so that so everybody can read them. But for more detailed personal questions, I suggest you look for them directly. They are only $20-something fee only. One zi cha, it costs more than that anyway, right? So, but I think they do has done us a great job tonight, right? So
Thank you so much.
Yeah, so let's give them a blast of likes as a replacement for the applause, shall we? Okay. Yeah. So thank you. And for those on YouTube, just write thank you, Chun Ting. Thank you, Money Hour. Okay. Really appreciate all this. All right.
Thanks for staying with us.
Yeah. Thank you. Right. Thank you.
Thanks, Lou.
Okay. Yeah. Thank you. Thank you so much for everybody. So remember, form +1. Okay. Form +1. And enquiries@moneyhour.com.sg. Yes, you're very welcome. Remember, Mr. Lu and B do not get a single cent out of this. So don't think we're conflicted. We're not. So we only pick companies we know are like-minded to us. Most importantly, they are good for you. Okay, they give you the best education and best advice. Okay, cool. You can see there, right? Okay, right. So great. You'll find it's a great company. They're located in Keong Saik Street. The best thing is come and look for them, and then after that, go and look for all the good food opposite. Yeah, the food here is amazing, man. Amazing. Yes. Okay.
Yeah, check us out online also.
Yeah.
There are a lot of things you can do online. Some of those insurance calculations, all that, they're actually online. Finding your roller coaster, that's also on our robo as well.
Cool. Yes. Thank you. So have a good night. So don't forget, tomorrow for Premium More, there's a great sale that's going on. Shopee is funding 7% discount. Okay, we'll launch more information tomorrow at noon. Okay, yes, you're all very welcome. Okay, you're all very welcome to join us on this wonderful finance talk as well. Okay, yes, thank you very much. Thank you. Thanks everybody. Chai-Ling, thanks for joining every time. Adeline as well. XQ as well. Gwendolyn, yes, thank you. Yes, thanks for giving the likes already, okay? Yes, thank you. Andy, thank you, okay? Yeah, I usually spend 5 minutes saying thank you.
So many
Grace,
people thank
yes.
Yeah,
Thanks,
indeed,
okay?
thanks very much, indeed.
Okay, cool. This is usually a very siong and chim topic, to be frank with you, okay? Yeah, it is a very siong and chim topic, especially on insurance part. But fortunately, Chun Ting make it very easy for you to understand, okay? Yes, so really let's appreciate them, okay? Before I sign off and say a few words of thanks to them, right? Cool. I mean, there's I'm a beneficiary as well. Okay, I learned a lot tonight, and then I have a wonderful chendol cake, and I ate
eating my blue cake.
and I also ate a wonderful Michelin recommended
Zi
Zi store just now. Cool. All right. Good. Okay. Good. Okay. Thanks everybody for joining us. We'll see you tomorrow night at around 8 p.m. as well. Okay. Tomorrow is pure high-powered premium more stuff. Okay. Yeah. Not on YouTube. YouTube is pure finance. Okay. Cool. Okay. Thanks for all of you tonight. Thank you for joining us. Thank you so much. Okay, thank you. All right, thank you so much. Okay, it's time to say good night. Okay, so I'm gonna say good night first to Instagram. Okay, thank you. Then I'll say good night to Facebook.com, premiummod. Thank you.
Thank you.
All right, benefit a lot. See, everybody, thank you. Okay, remember I put form +1. Form +1 to fill out the form. Show your interest. Okay, form +1 doesn't cost you a single cent. Okay, yes. Yes. Thank you. Form +1. Okay, we'll see you tomorrow. Okay, yes. If not, just email at money hour. Sorry, enquiries@moneyhour.com.sg or just go to our website. Okay, yes. All right, good. Okay, so with this, yes. Okay, with this, really appreciate you joining us. Okay, all right, we'll see you. Okay, I'm now go back to my jet lag. I'm half dead now. Okay, all right, cool. All right, I'm gonna off this now. Okay, I'm gonna off this now. Okay, so YouTube, all right, good night to you, about 400 of you guys. Okay, thanks for joining us. I'm gonna off this now as well.